run higher for longer if this kind of loosening continues.
Can you give us a sense of just how much more bullish you got after that press conference? Basically, did you go out and just press buy?
I think, yes, absolutely. I mean, I think we saw it. What was interesting is the last time I was on Bloomberg, I was actually very bearish because I was concerned about rates being higher for longer and everyone really being concerned about the risks of inflation to the upside. And then, the Fed being concerned about inflation reaccelerating, but the data points we were seeing right then were actually very concerning. And so instead of being bearish, what you needed to be was bullish to say, wait, well, the data's getting worse, so rates are going to come down, and that's going to loosen financial conditions. And what we saw again is we saw that Powell really was channeling his inner Bobby McFerrin, don't worry, be happy. You know, in the press conference, something happened in the past few weeks where he probably was seeing some data that was concerning him that things could get worse. And so as a result, he decided, well, loosening financial conditions don't matter because I'm more concerned about jobs than I am about inflation reaccelerating at some point. And if all they're focused on is jobs, there's going to be a really high bar for them to actually become materially more hawkish. At the same time, the market has even gotten ahead of their 3 cuts, right? They're still not talking about cutting anytime soon.
Maybe.
Right. I mean, but if the data is negative, like there is this Fed put there, like they are going to support this market. They don't care about valuations of stocks that don't make sense to me in a lot of cases. So when we look at the market as a whole, we think the market as a whole is very expensive. We see analysts continually chasing like, oh, this company's going to bring down numbers, but everyone knows it, so we should pay a higher multiple. We don't think, though, that's sustainable forever, but we do think that in more cyclical areas of the market, valuations are still much lower than elsewhere, and so running a long-short portfolio, it is, I think, wiser to pay attention to valuation in these times.
The balance has shifted at the Federal Reserve, without a doubt. Avery, it's good to see you. Thanks for joining us. Avery Sheffield there at Vantage Rock at Rockefeller Asset Management. If you are just joining us, welcome. State of play, the scores look like this. The S&P 500 positive by 0.1%. Yields a little lower by 2 basis points, 390.89. Crude softer, rallying through much of yesterday. We're back to 72.40 on WTI, negative by 0.1%. Tons of feedback on the effective shutdown of the Suez Canal. Started with Torsten Slok over at Apollo, who said this: rising uncertainty in the Suez Canal combined with the global economy rebounding because of easier financial conditions, Torsten says, could put upward pressure on goods inflation over the coming months. This just dropped from Andrew Honhorst of Citi. The effective closure of the Suez Canal trade route is now an upside risk to goods inflation. Lisa, I know it's a topic you're watching closely.
How could it not be? This is the exact same thing that we saw when shipping channels get disrupted. That leads to a longer wait time to get supplies. And that means also more expensive costs for the extra fuel, for the extra hours. I mean, this is all kind of a clear trajectory to higher prices. It's just the big if this gets prolonged. If
Anne-Marie joins us on the if up next in Washington, D.C. If it gets prolonged, what can officials do about it? Then later, 8:30 Eastern Time, 1 hour and about 16 minutes away, Rich Clarida, the former Federal Reserve Vice Chairman, and PIMCO, Global Economic Advisor from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The bottom line is that we've got to get it done. Both the military assistance to Ukraine, other military assistance, as well as addressing this border security issue. And of course, at the end of the day, we're going to need bipartisan support to do that in the Senate. We will have to come together to get this deal. Exactly when, as you say, is not clear. Progress is good, but we need to get it over the finish line.
Is that support there? That was Democratic Senator Chris Van Hollen speaking to Anne-Marie Hordern and Joe Matthew on Balance of Power last night as signs of a border deal diminish going into the new year. From New York City coming into this morning, good morning to you. Equity futures on the S&P positive here by 0.1%, elevated over the last couple of months. We're looking at the prospect of 4,800 on the S&P 500 a little bit later this morning. Yields are lower by 2 basis points, 390.70. Elisa, the everything rally continues.
And there's no real reason for it to stop, as we keep hearing from one investor after another. The Fed has told us their game plan, and if there's weakness, they're going to come in with the Fed put. And that has been the message, regardless of how much walk back we try to hear from some of the other Fed officials.
Jason Trenner, Strategas, a second wave of inflation.
Yeah.
Starting to consider a second wave. Things happen. What's happening right now is that traffic going through the Suez Canal has been grinding to a halt through the Red Sea. And this is what we're hearing on the south side, on Wall Street. This from Andrew Hollenhorst of Citi. The effective closure of the Suez Canal trade route is now an upside risk to goods inflation. We heard on the buy side from Torsten Slock over at Apollo that rising uncertainty in the Suez Channel, combined with the global economy rebounding because of easier financial conditions, should put upward pressure on goods inflation over the coming months. Could, Lisa? Could put upward pressure, and this is a could we're all going to be watching.
Especially because it's unclear what the coalition is going to do without the participation of Middle Eastern nations. If you noticed, the list of the coalition that came together to try to protect this shipping channel included Europe and included the U.S. It didn't include some of the biggest players who could potentially pressure the Houthis or other players in this. I'm not an expert in this. I really want to understand from experts exactly what needs to happen to make this a viable shipping channel at a time where insurance costs are skyrocketing, and so too are fees.
Well, let's get to someone now who knows what's happening. It's Anne-Marie Hordern, our Chief Washington correspondent down in Washington, D.C. AMH, let's start there. What's being done to reopen that channel?
Well, right now you have the Pentagon talking about a new maritime task force to try to make sure that there's security within the Red Sea and this channel. The issue is, Jonathan, is that a maritime task force already existed here. The U.S. has 2 aircraft carrier groups here, but obviously there's a tremendous amount of concern amongst companies right now, given the attacks they are seeing from the Houthis. But what you can see is that the United States is trying its best to work with international partners to try to make sure that companies can continue to use these waterways and not have to redraw the map for goods, for oil, because what that would do would be another shock to the system, which global economies have already lived through with the pandemic. So there's going to be this international outreach, this maritime consortium, but we should remind our viewers that this already exists. So I'm just questioning what this new group can do that the prior structure was not doing.
I want to understand, Anne-Marie, what's on the table. I mean, is this basically a reluctance to take military action against the Houthis or to have something more sustained and to try to talk it out instead? Is that basically what this is aimed at?
Well, at the moment, the Biden administration wants to use diplomacy. They do have ways of dealing with Iranian proxies via diplomatic channels, most notably in Oman. What a source has said to me that there's a lot of debate right now and friction within the Biden administration on if they go on the offensive or, I guess, the defensive, but actually attack the Houthis, which we've already had missiles come at our ships and other cargo ships in this area. There's a lot of debate because does that mean the United States is going to get involved in another conflict in the Middle East? So that is the debate right now as they are trying to unwind or trying to put some pressure on the Israelis, or a tremendous amount of pressure at the moment in the Israelis, so they can stop their bombing when it comes to Gaza and their attack right now in southern Gaza. So while the United States is trying to force the Israelis to really start to slow down their offensive in the Palestinian territory of Gaza, what you have at the same time is they're consternation and concern about getting drawn into another conflict when it comes to the Houthis.
I'm just wondering, Anne-Marie, I know that you have a lot of conversations off the record with a host of different officials in Washington. Do you get the sense that people feel like this is going to get resolved? Or is this a real concern where people don't have a sense of exactly how they can unwind this in an easy way?
Well, if you're talking about the Houthis, this has been an issue for years that the U.S. has dealt with via their allies, whether it's Riyadh or Abu Dhabi. I'm not sure anyone thinks this can get unwound very quickly. This is why they're doing a tremendous amount of diplomatic outreach to the Gulf and via Oman, Bahrain, Saudi Arabia, and the United Arab Emirates. The concern, of course, is this is a massive risk, not just militarily, but of course, what does this mean for global economies, the supply chain risks for goods, if you have to redraw the map? That is going to be inflationary on goods and also on oil. And right now, it's been a sigh of relief for this administration that you have gasoline prices in America where they are, just hovering a little bit north of $3 a gallon. When you continue to look at poll after poll, and just yesterday, the President of the United States received his lowest approval rating since he took the job in this Monmouth University poll. And only 3 in 10 Americans think that he is doing a good job when you look at the concerns that are top of their mind, most notably the economy and inflation. So this has dual potential concerns for this administration. Of course, it has the defense and military concerns of our armed service men and women in the Gulf, but also what does this mean politically going into an election year?
Let's bring it home and talk about what's happening domestically then. This from Greg Valliere of AGF this morning, Anne-Marie. A gloomy holiday season for Democrats. It's impossible to exaggerate the mood of despair among Democrats in the nation's capital. Anne-Marie, from your perspective, just how bad is it?
Well, it is pretty bad. And we saw yesterday that the Biden administration, Biden himself, is talking to his team, according to the Washington Post, asking, why is my message not resonating? Why are my poll numbers so poor? But you know what stuck out to me, Jonathan, in that Greg Valliere note today is building on the Wall Street Journal reporting over the weekend, quote, Obama has huge clout within the party, and we're hearing that he is privately telling Democrats that Biden probably can't win. This is not news. Your former president you used to work for when you were VP, this is not welcome news for President Joe Biden or his team.
Next paragraph in the same note, Greg asked the question, is he dropping out? Everyone's been asking that question for a long time. Any sign of that whatsoever?
Not at the moment. Not at the moment. He's not dropping out. For someone to get in, it'd be incredibly challenging at this stage of the game. It is very late in the year. They would have missed the filing deadlines in a number of key states. Potentially, if things do not look good for him in the summer. But, I mean, I think this is some people just hoping for something new within the Democratic Party. But at the moment, Joe Biden is set to be their candidate in November of 2024.
AMAs, thank you for the update down in Washington. Anne-Marie Horton there, our chief Washington correspondent. Lisa, let's build on that. The calendar. The one thing arguably on his side is the calendar. That we've got another year to go, 11 months, 12 months. And that
so far this has been more of a proxy, the sort of polls have been more of a proxy on how people are feeling right now and their anger toward the inflation, toward specific issues with President Biden. Donald Trump hasn't been the news. He's been sort of the other guy, right? He's been the fallback guy. It's not necessarily, the polls don't show that there's an incredible amount of enthusiasm. It's just that there is a lack of enthusiasm right now for President Biden. So this raises this question, is he operating in the same kind of way that President Biden did to win the presidency the first time by simply being, I'm not the other guy, rather than running as who he is himself?
Well, think about how the election played out last time around. We're just coming out of the depths of the pandemic. The current president barely even campaigned, didn't need to, made it a referendum on the incumbent. And now you face a very, very different set of circumstances going into 2024.
And, you know, we keep asking this question on the economy, which a lot of people say is not doing well. The economic data points to something different. So if the frustration is building at the White House, what are they going to do about it?
Amazing how miserable everyone is in Washington and how happy everyone seems to be on Wall Street with this equity market rallying back towards all-time highs, isn't it?
I mean, at certain...
Quite a difference.
It's just a complete opposite. We've had a huge wealth transfer from the government to businesses over the past, 6 years.
Corporate America to consumer household balance sheets as well. That's been the pandemic story, I guess.
And I guess people are very happy about that.
They're miserable in Washington. Apparently they're happy on Wall Street. Equities right now on the S&P positive by 0.16% from New York City this morning. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocks are just about positive. They've been positive now for the best part of 2 months on the S&P 500. Grinding higher again by 0.1% on the S&P, on the NASDAQ by 0.1% also. The Russell, the small caps, really leading the way on many an occasion over the last week or so, up by 0.6% on a Russell this morning. So we've got a NASDAQ 100 at all-time highs, Lisa, and S&P 500 not too far behind.
And really, this raises this question, okay, is this truly the rotation that we've been looking for? Because we've seen head fake after head fake with the Russell 2000 outperforming. We've finally seen it over the past month. Can you bet on that? No one's willing to say we don't like big tech. That's one thing that I hear. People might say, well, we're rotating into cyclicals, but we're still holding a lot of big tech because that's always going to win. And if anytime you try to bet against it, you get slammed.
Price always sets narrative. We often say that, everybody says that, and you're always trying to find explanations for what's happening, and then people start to extrapolate the present out into the future. The issue I have with the rotation, the breadth, the improving breadth, Is it anything more than people have underperformed in 2023 and are chasing gains and don't want to go to the high-flying tech names, so they go elsewhere to the places that have been beaten up? And when I look at the banks, are the banks anything more than just a leverage play on what's happened in the Treasury market over the last couple of months?
I would argue no. It's been a very direct correlation. There is, though, this underlying feeling that if the Magnificent Seven has gained, what, 76% so far this year, 75%, something like that, year to date. The rest of the overall index, about 12%. If you believe that the conditions are set that are more in line with where the high flyers have been, well, then play catch up. And that sort of makes sense at a time when you feel like there is the Fed put back in the game.
You start thinking about small caps and an equal weight S&P 500.
Europe.
You know, if you equal weight the Mag 7, you know, if you equal weight them, so you give NVIDIA a little bit more weight than you would have done, there's something like up 100% or something like that.
That's nuts.
It's ridiculous. And then you play into Meta and all of that stuff too. It's amazing to me that Apple is up something like 50% year to date, when if you look at iPhone sales this year, not being tremendous, not being great, just a cash machine, just an absolute cash machine.
Yeah, but Apple Watch is flying off the shelves. So there you go.
We'll
Maybe
get
that's
to that story
you know,
a little bit later. Yeah, you know my thoughts on that. Just the convenience of, no, it's coming off the shelves on Christmas Eve. Oh, no. Oh, they're terrible. Okay, let's turn to bonds. 2-year, 10-year, 30-year. Go and buy an Apple Watch right now.
Yeah.
10-year yields down by 2 basis points. 390.70. 2-year down by 2 basis points. 442.25. Lots of Fed speak. I think stand out for me. San Francisco Fed President Mary Daly. Look, on the dovish spectrum on the FOMC, most people would assume that becomes a voter next year, the San Francisco Fed, talking up 3 rate cuts as not being particularly accommodative anyway, which is where the consensus is right now in the committee based on the median dot and what's implied for next year from this Fed.
If you have disinflation, according to Mary Daly and according to many people in the economics profession, cutting rates is simply keeping conditions in line with where inflation is at. And that's basically what she said. If they cut 3 times, they're still going to be quite restrictive based on where they expect inflation to come in. So here's the question. Is inflation, A, going to come in? And B, is it going to be a head fake, especially with the likes of Andrew Hollenhorst and others talking up the probability of a reignition of inflation later in the year?
Jason Trent, strategist on this program earlier this morning, talking up the prospect of maybe a second wave of inflation next year. Let's turn to foreign exchange, the dollar against the yen. The BOJ, about a month ago, this meeting was meant to be live, and then in the last couple of weeks, this meeting's no longer live, and nothing really happened. 144.58, dollar yen gapping higher by more than 1 full percentage point. That is a weaker Japanese yen. More on that in just a moment. Under surveillance this morning, Houthi attacks shutting down shipping in the Red Sea. U.S. Secretary of Defense Lloyd Austin saying the U.S., UK, Canada, France, and other allies agreeing to a new naval task force to counter attacks in the region. Quote, this is an international challenge that demands collective action. How quickly, Lisa, can they move?
And what exactly are they going to do? Because none of these countries actually want to have a military altercation. They don't want to put some troops on the ground to make sure that there is free passage here. So what are they going to do? Can they jawbone this? Can they get the allies in the Middle East to collectively prevent these attacks? There are a lot of big questions, and I don't know exactly what the fair pricing is, but we have seen a pop to oil prices and people saying, there's more room to run there.
Things are pretty calm in the commodity market. I know we saw a big pop in natural gas prices in Europe yesterday, but oil's still in the 70s on Brent. WTI about 72 this morning. Let's turn to the BOJ, leaving its policy rate unchanged. The decision in line with the ECB, BOE, and the Fed, who all held rates steady. But unlike Powell, Governor Ueda offering little insight on when to expect policy to change. The San Francisco Fed President Mary Daly did entertain rate cuts, telling the Wall Street Journal it's appropriate for policymakers to begin contemplating cuts next year, but it's too soon to speculate on when they might happen. So are they talking about it, Lisa, or are they not talking about it?
Jay Powell said they're talking about it. They're talking about it.
Williams says we're not talking about it.
We're not really talking about it.
Oh,
but
we're not
really means sort of, a more sort of prescriptive way.
Really.
We're not saying the date. We're not giving, writing up the documents yet. That's basically how I interpret it.
Well, I'm pleased we cleared that up.
Yep.
So no more Fed speech through the rest of today.
We're good.
Top story this morning, Apple. It's not really, but I'll go to it. Taking some of its best-selling devices off the market this holiday season. Kinda. The company will stop selling the 2 latest versions of its smartwatch in the US due to a patent dispute over its blood oxygen sensor. Online sales stop Thursday. Store sales end on Christmas Eve. The convenience of these dates. Look at the stock. Does not care.
Yeah, does not care.
Just about positive in the free market.
This is a $17 billion line of revenue each year for them. So if people thought that this actually was going to be going away or impeded in any capacity, you would see a bigger reaction in stocks. Either way, this is basically a new marketing scheme. We have a concern about copyright. You might not be able to get my product anymore.
After Christmas. Buy it now.
Well, I mean, honestly,
okay.
I don't know. The fact that the shares aren't responding gives you a sense of what they think
It
about
tells you everything you need to know, I think. Let's get to the bond market. Subhadra Japa, head of US rate strategy at SocGen. Subhadra, I want to talk about your call on the bond market. It's refreshing. It's not super bearish. It's not super bullish. It's just neutral. Subhadra, why is it neutral?
Well, into your end, I think that we've already seen a very large rally in treasuries in just the last few weeks. So it doesn't make any sense for the market to continue to rally from here on. We think that the bond market, at least over the near term, is going to lose some momentum, given the fact that we're priced nearly for 6 cuts for next year. So that seems a little bit dramatic. I think our view is that the Fed will deliver a hike starting in May, but a March rate cut definitely seems a little bit premature at the current time. As you were discussing earlier, John, you're looking at an outlook where financial conditions have eased quite dramatically. Inflation is coming down very nicely. Gas prices or oil prices in general have declined quite meaningfully. So the consumer is still relatively strong. So the risk here is that we might see a resurgence in services side inflation.
Let's build on that a little bit more. Where would that leave the call on the yield curve? Because traditionally, when we're talking about maybe the end of cycle, maybe the start of a rate cutting regime, you'd get that bull steepener come through the curve. Subhadra, what's the call for you and the team now through next year?
So our call in our outlook that we published in the end of November was that the first move would be towards a bull flattener with the front end pegged and the long end rally, but that hasn't happened. The market has priced in a lot of cuts in a very short amount of time. But the long end has also rallied, so the two-stance part of the yield curve is still quite inverted. You are going to see that disinvert and steepen out with the as we progress, but that's going to be more of a mid-2024 story. When the Fed starts to cut rates aggressively, you're going to see that curve steepen out. So for now, I think that inversion is very much in play because investors are getting back into the bond market in a big way across the curve. You're seeing this FOMO trade play out, and that would mean that with the front end pegged to Fed expectations, investors are going to also buy the long end.
I was struck by the Bank of America Global Fund Manager survey that showed people really going out of cash and into bonds. Cash was cut to a 2-year low, and people were the most overweight bonds in 15 years. Have we already seen the rotation out of cash, out of money market funds that would have transpired given the potential for rate cuts?
Well, I think that what you're seeing is an asset allocation towards bonds, given the fact that people have concluded that bond yields have topped around 5% is as high as it gets. If that's the case, you're going to get the best yield you've ever had in the last couple of decades. So it makes sense to allocate into bonds as well as perhaps other assets, but bonds first, because the sequencing, the way it's going to work is, as the Fed prepares to cut rates, the economy slows down, you're going to see bonds rally first, and then if we do see a recession like we're expecting at SocGen by the middle of next year, then you should see some weakness in equities, and then you'll see the asset allocation into equities. But that's really not how it's playing out. There's just a lot of cash in the system, $6 trillion or so, close to that in money market funds, and that cash is just being reallocated into other assets where you could potentially get higher returns over the longer run.
So can you give us a sense of how much lower you think 10-year yields are going to end next year, given the fact that there still is a lot of cash to flow into bonds and you do expect weakness in the economy?
So, our call for 10-year yields is for 10s to get to around 375 by the middle of next year. And the reason for that is is because we think that the U.S. economy goes into recession. So we do see more room for 10-year yields to rally. I mean, granted, when we put out these forecasts, 10-year yields were close to 5%. So 375 seemed like a stretch, but we're almost there in a very short amount of time. So yeah, could we see 10-year yields dip below 375 perhaps? But really, the core story that I think that I'm sticking with is the fact that the sort of term premium buildup that we saw over the last, I'd say since August to the end of October, that story is still very much in play. You're seeing the supply-demand imbalances continuing to plague the market. You're seeing tailed auctions. There's just not as much demand for treasuries as we've seen in the past. And the Fed, our call is that the Fed is going to continue to do QT, not just into the end of 2024, but also into 2025. So given that sort of dynamic, it makes sense that you start seeing a buildup in term premia once the Fed starts cutting rates and the economy starts to stabilize.
Subhadra, this was excellent. Just fantastic to hear from you. Thank you. Subhadra Japa there of SocGen on this bond market. Lisa, let's piece it all together. In the equity market, the calls very similar to the calls in the bond market. So people like Subhadra making a call for next year on the US 10-year, looking for the yield to come to 375 at a time when they're putting that together, the yield's at 5%. Got the likes of Goldman Sachs coming out and saying 4,700 on the S&P 500. Oops. We get there, and then they have to lift their price target through 5,000 for year-end next year. They're chasing it. They're chasing the equity move because there's a feeling that something changed with Chairman Powell last week. I didn't hear that from Subhadra just then on the bond market at all.
And as she was speaking, I was wondering, is the bond market different because it is going to be more susceptible to some of the quantitative tightening, the selling or the rolling bonds roll off the balance sheet, as well as a deficit. And it's going to be a political season. It's going to be one where we're not going to get a whole lot of resolution when it comes to just how much the deficit has been expanding.
Subhadra Japa there of SocGen. If you are just joining us, welcome to the program. On the equity market, just about positive on the S&P 500 by about 0.15%. Yields are lower by a couple of basis points. We're down 2 or 3 to 390.51. Coming up in the next hour, a conversation you do not want to miss. It's Richard Clarida, the former Federal Reserve Vice Chair and PIMCO Global Economic Advisor. Lisa, you'll be leading that conversation at about 8:30 Eastern Time.
You can stick around. This is going to be a key one. I think it's going to be interesting for him to parse through the discrepancies between the tone of some of the Fed officials. What does he make of the fact that Fed Chair Jay Powell has a very different tone than, say, Austin Goolsbee, and that they're both saying that they're on the same page, although we haven't heard from Jay Powell? I would be curious if he'd come back out again and say, hey, I said what I said. I meant it.
Newport Beach, California, June of this year. PIMCO releases their secular outlook. I sit down with Rich, and he talks about this Federal Reserve accepting 2-point-something inflation. 2-point-something. Wasn't the big conversation at the time. You'd have to think that maybe the world is moving towards Rich based on what we saw take place last week.
That's what Avery Sheffield was saying, that essentially this was a tacit acceptance of a higher inflation rate for longer in order to preserve the jobs economy. That was really the shift.
Alex Webb on a big story with Apple coming up next. Lisa's excited for this one.
Oh, yeah.
Go get your Apple Watches before they come off the shelves on Christmas Eve. From New York City. A beautiful New York this morning. Good morning to you.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
If you have inflation that is decelerating and rates that are coming down, that tends to be good for growth. We want to be a little bit cautious around the Magnificent Seven, given the rally there, given the 40% overvaluation there of those stocks relative to history. It's about a third of the index if you look at the top 10 stocks, but only about 20% of the profits. People think all the profits are coming from the Mag 7. There are other sources of profitability. So I do think we think a little bit about the broadening.
We've seen a lot of that in the last couple of months. The brilliant Mira Pandit there, global market strategist at JP Morgan Asset Management from New York City this morning. Good morning and welcome to the program. Stocks more broadly positive on the S&P by 0.1%. Yields down again by 2 or 3 basis points, 390.33. We're talking up the everything rally. Bonds rallying, stocks rallying. And for a moment yesterday, Lisa, commodities joining in.
Because, though, of a different reason, right? And so this is really what people are watching. This could be a potential red herring rather than something participating with everything else. Concern around shipping routes, one of the biggest in the world, getting blocked by Houthi militants attacking shipping container ships, as well as tankers, oil tankers. This, to me, is a huge potential headwind if it continues. I don't know how much clarity we're getting right now about what the parameters are of it continuing.
How many Apple Watches go through the Suez Canal? Do we know the answer to that?
I don't know, but I do know someone who does. Alex Webb can give us all of that.
Alex Webb joins us now, scrambling to get those numbers. Alex joined us out of London. Alex, a serious story, so let's focus on the serious aspect of it. So we're days away from a US ban, a potential US ban of the smartwatches, the newest smartwatches that Apple is selling. What is that issue right now currently, Alex, and how do you see it being settled?
So essentially there's a medical device or technology company out in California called Masimo, which has successfully asserted that Apple infringes upon its patents with the blood pressure monitor in its most recent smartwatches. And so the International Trade Commission, that's a US government agency, has therefore said that Apple cannot sell these devices starting on December the 25th. So there is the possibility always that there's some sort of settlement between Apple and Masimo. It doesn't look like that's going to be the case, at least based on our colleagues reporting. What Apple is now trying to do is find a workaround on a software basis, that it will change the algorithms in a way that therefore don't infringe upon the patents. Unclear whether they can do that, because this looks like it might also be a hardware problem. So there's a few different possibilities, but right now it looks like starting on Thursday you won't be able to buy them online in the US, and starting on Christmas Eve you won't be able to buy them in Apple's own retail stores in the US.
Alex, just to build on that a little bit more, any signal from Massimo what they would like out of this dispute?
I mean, they've said that the statement they've given is that this shows that no matter how big the company is, you can't just use your weight to get whatever you want. Typically in the past, in these sort of cases, there have been financial settlements. Now, there are estimates that that the Apple Watch generates something in the order of $17 billion a year in sales. Only then a slice of that will be for the affected devices here. It's therefore unclear. Presumably then, there would be some sort of settlement that will be a slice of the profit that they make from those devices. But we're a long way from seeing that happen, even though a lot of other cases that don't involve Apple tend to lead in that direction.
As you're talking, Alex, shiny pictures of the Apple Watch are flashing on the screen with all of the potential bonus features that people can get. There is this question. We haven't really seen any reaction whatsoever in the shares. Is this really such a big deal, or is this convenient for Apple that we're going to essentially get people rush to the stores to get theirs before the end of the year?
Well, I mean, yeah, that could well be the case, but let's, as you say, put this in a little bit of context. Apple, in its trailing 12-month revenue, is generated about $380 billion in revenue. The Apple Watch, the entire segment, generates an estimated $17 billion in revenue, so the whole segment is about 5% of total revenue. Go even further, how much of that is within the US? I don't know, 30, 40%. So all in all, it becomes a bit of a rounding error when it comes to Apple's overall numbers. Now, it's still kind of useful for Apple, not least, yes, clearly you make decent money from selling it, and for any other company it would be a sizable chunk of their income, but they also tie people to their iPhones. If you have an Apple Watch, you spent $300 to $500, you're probably not going to go and trade in your iPhone, which is necessary in order to keep the Apple Watch running. So it's a very good way of building stickiness, even if people don't refresh their Apple Watch as regularly as they might do a smartphone.
Do you have a sense of whether regulators have the backs of the likes of Apple just simply because of their place in the economy, or the opposite? There was some potential discussion about a reprieve from regulators.
Yeah, so the other possibility here is that the White House overrules the ITC and says, actually, no, Apple should still be able to sell them. They have done that in the past. A decade ago, there was a dispute over patents between Apple and Samsung. But of course, the difference in that instance is that Samsung is a South Korean company. Massimo, the company that Apple's in dispute with here, is an American company. So you'd be ruling in favor of one American firm over another one. That's a very tricky position for the government to be in, and therefore a lot of observers seem to suggest that it would appear to be a less likely eventuality.
Not a great week for Apple. We talked about it yesterday, Alex. What's happening in China with the iPhone?
Yeah, it does seem as though that is a more significant headwind at this stage, that there's been a steeper crackdown on the use of Apple devices inside not only government agencies, but also state-owned companies. Formerly, it was the case in sort of 2 regions. Now that's been extended to 8, according to Bloomberg reporting. The challenge of that is not necessarily the direct sales to government employees and state-owned company employees, but what it says about attitudes towards Apple within the company. When this has happened in the past, we've seen a big chunk taken out of their sales in that part of the world. They lost about 20 billion in sales over the course of 4 years when there was a similar move to this. China has been a bright spot recently for Apple's growth. So if that were to be the fallout from this, it would be a far more considerable repercussion than what we're seeing with the watch.
Is competition increasing as well, Alex? We talked a lot about the Huawei Mate Pro something. Alex, how well is that particular phone, that product, doing?
It's quite hard to tell because, Huawei doesn't publish those numbers. We've seen estimates that say they're sold out. Well, we've seen reports that say they're sold out. We don't entirely know whether that's to do with demand or with a constraint on supply, because at the heart of this Huawei device is a chip that is supposed to be a lot more advanced than people thought possible for China to develop domestically. But that also might mean that they can only produce a limited number of them. Now, there is increased competition within China across the board, and that clearly creates a problem. But China, even with this more advanced Huawei device, remains a few years behind the bleeding edge of what's in the latest iPhones, about maybe 3-4 nanometers, which is 50% more powerful in very crude terms.
From what you hear when you talk to tech executives and analysts, do you get the sense that the feeling is thawing toward China and continuing to try to play in that sphere, or that people are just quietly accelerating the shift away from the country because of the inconsistency that they've seen in some of these policies?
I think the second part seems to be very much the direction of travel. You keep on hearing conversations about efforts to thaw relations with China, but then at the same time, policy goes seemingly in the opposite direction. You are still seeing an acceleration of production capacity outside China. Foxconn, which is one of Apple's biggest contract manufacturers, bringing more capacity to India. Foxconn itself investing in, for example, automotive manufacturing, which a lot of people are saying, well, suggests that they're not as optimistic about the smartphone market going forward. There's a lot of diversification going on right now, much of which is the fallout from those fears around China and how promising a market it will continue to be. Don't forget, the one massive caveat to all of this, Apple has an incredibly symbiotic relationship with China because it employs millions of people there, both directly and indirectly, to manufacture its devices. So China can't just cut them out of the market without doing a huge amount of damage to their own citizens.
Alex, appreciate the update. Thank you, sir. Alex Webb there of Bloomberg out of London. We'll try and catch up with Alex a little bit later. Don't want to start conspiracy theories, just saying it's highly convenient, maybe even a gift, that the International Trade Commission starts that ban on Christmas Day.
Yes, I would say that that's fair. I mean, we don't know. I mean, it's not necessarily.
It's a gift, just by definition.
It's a gift because people are going to go out and buy. As I was saying, you see the flashy things. Do you have an Apple Watch?
I do not, no.
Would you want something to read your blood pressure and your oxygen levels?
I've got one of them
in your sleep?
On my wrist, yeah.
Oh, really?
Yeah.
Okay, but you
I just don't
want
want
to have
the screen
messages?
on it. No, I prefer a dress watch. That's just my preference. I don't like those big, chunky tech things on my wrist, and I don't want the distraction of the screen either.
Traditional.
I want to focus on the people at home, at financial markets. That's what's important to me. Too cheesy for you?
That was so horrible. Please stop.
Sorry, I apologise. I take it back. I don't want to focus on you at all.
Exactly. You should
Chris
not focus on your watch.
Heisey of Maryland Bank of America Private Bank is going to join us very shortly. Let's check in on the price action. Looking forward to that conversation. The bulls out in force over the last week and feeling very, very good about themselves. Jay Pilowski of TPW loving what he calls the external validation that he's been waiting for. The equity market leads are positive again this morning.
And it has been a bonds and stocks story. And this, to me, is the biggest question for next year. When do they diverge if we start to see weakness and the bond rally is supposedly negative for stock rally? It was supposed to be now. Not so much.
Chris Heisey coming up next on the equity market, very close to all-time highs, and then we'll catch up with Ellen Wald of the Atlantic Council on the Suez Canal grinding to a halt. From New York City, this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
2023 was a year where, despite having concerns economically, we held our nose and we bought.
The wall of worry doesn't exist right now.
What we are definitely seeing is something that looks like post-pandemic normalization.
It has been an absolutely enormous rally here, and they're pricing in a tremendous amount of cuts.
If the Fed is successful in pulling off the soft landing, I would make the case that you hit a little less, rate cuts.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK, I'm told, back with us tomorrow morning. Last show of the year altogether. Last show of the year altogether tomorrow.
I know, we'll have to celebrate the holidays.
Just before you get too excited about getting away for the holidays, a few more trading days still to go. Equity futures on the S&P 500 this morning, positive by 0.2% on the S&P. But Lisa, the train has left the station. And this Federal Reserve trying to pull it back, but it's gone, and it's not coming back.
And what we've heard from one investor after another is they have no reason to pull back because essentially the Fed put is back. And we laughed about this. Ben Laidler came on more than a month ago, and he said the Fed put is back. And we said, are you kidding me? That's ridiculous. And then one person after another, and then Fed Chair Jay Powell himself. They're concerned about jobs. And you know what? They're talking about rate cuts.
The Chairman Powell, December 1st, different man to Chairman Powell last Wednesday. And the cleanup job we're seeing now sounds a little bit more like Chairman Powell on December 1st, but you can't forget what you heard on Wednesday. You can't put that to one side and say that didn't happen. And already implied in the dots, three cuts next year. Market's taking it further, I get all that. But you've got doves on the FOMC now, Mary Daly of the San Francisco Fed saying 3, that's not accommodative at all. And the worry, this is the shift, and you've touched on it. It's the balance of risk. We're super worried about inflation. We need to cause pain to get inflation down, so be it. So be it. And now the turnaround we've seen in the last few months, we don't want to damage jobs to get inflation down, is essentially what we heard from Daly yesterday in the Wall Street Journal.
I have a lot of respect for Mary Daly, and I was reading her comments, and I thought that they were pretty transparent. The problem here is that the market is moving ahead of the Fed, and the problem here is that accommodative conditions in the financial markets can affect the chances of getting inflation down. So here is the question ultimately, is this Fed more willing to allow inflation to remain higher for longer in order to preserve the labor market? Is that the new shift, the 2-point something that Rich Clarida had been talking about?
So this hour is set up perfectly for that with Richard Clarida, the former Fed Vice Chair, just around the corner. PIMCO's very best joining us in about 27 minutes' time. Theme of this morning already started at 6 a.m. Eastern Time. Jason Trennett, strategist. He thinks there's a risk of a second wave of inflation off the back of the easing financial conditions we've seen in the last few months.
This is the reason why whenever I get a note from Andrew Hollenhorst at Citigroup, I always open it because he's been saying the same thing. People now pointing to the potential for some of the shipping routes being upended as having inflationary pressure. But the bottom line is this. Historically, there have always been these sort of echoes of inflation. And historically, you have seen when people start getting confident and they have higher incomes, they go out and they buy, and you could see prices pick back up again in a new way.
There's always something to worry about, isn't there? What's that song? Someone mentioned it earlier. Don't worry, be happy.
Yeah, Bobby McFerrin.
Don't worry, be happy.
Are you telling me that?
Don't worry, be happy.
It's in my blood. I mean, honestly,
course, yeah.
And honestly, the amazing thing is I'm seeing all these investors.
I know that song hits you deeply.
I
feel
would try
exactly
to
the same way. Sure.
Stop.
Here are the scores right now on the
Thank
S&P
you.
500. We are just about positive by 0.2%. Your bond market set up as follows. Rallying still. Yields lower by 3 basis points. 390.14. The traffic in the Suez Canal grinding to a halt. We've seen warning after warning from Maersk, then BP, on going through the Red Sea. Looking at commodities, I would say pretty calm relative to the conversation that's happening elsewhere. 72 on WTI, we're negative 0.4%. Brent, south of 80.
Kevin Book came on yesterday and was talking about how he's surprised there hasn't been more of a reaction in the commodity space. Why are people looking past this, considering that it's 12% of global trade? That's a good question. It's unclear, especially because Anne Marie just came on and said it's hard to see an easy resolution to this anytime soon.
Commodities are touch lower, but down 0.3% on Brent crude this morning. Chris Heisey joins us now, Chief Investment Officer at Maryland Bank of America Private Bank. Chris, let's start here with the dream, the story for next year, if you will. This is the story. So inflation is going to keep coming down, growth is going to be okay, and the Federal Reserve is going to cut interest rates, and the equity market's going to keep it on exploding higher. So that's the story. Can you tell us how expensive is that story now for next year, given the rally we've had in the last 2 months?
Well, it appears expensive because of how fast it's been priced in, but we have a long way to go. There's still a lot of cash on the sidelines, not just from an investor perspective, institutional and private client, but also the corporate cash, still earning a very healthy return at the short end of the curve. That's keeping margins wide. And with the debt structure in the corporate markets right now, overall, their liabilities are still low. So we can chunk out some very solid earnings here. And Lisa was talking about this echo of inflation. I think that's the perfect way to think about it. There are echoes. There's going to be a lot of echoes about, are we having a soft landing? There will be pockets of bumpiness, and that'll keep investors a little bit still concerned. Right now, the wall of worry, may be a little bit lower than normal, but that wall doesn't go away. That wall ends up rising a little bit as we get into next year.
There's like 5 bricks left in it, Chris. I'm not sure what you're talking about. What bears are left?
There's a lot of bears. They'll come out of the cupboard again and out of the cave as soon as you see one bad number, either on the earnings front, on the inflation front, or something like that. And that will actually cause some second guessing. But we think there's a lot of room to go here. We're not out of the woods, and we have a lot of work to do. But we're not fully priced in.
So, Chris, you're saying that the bears still exist. You're just not one of them after hearing from Jason Trennett, the Fed shot the bears, and from A.V. Sheffield, that Powell's press conference reminded us that the Fed's ultimate goal is not price stability and full employment, but rather to make people happy. So in other words, how much can people remain bearish with a Fed that essentially has a big put and they're putting it in?
Well, I think the bears got very frustrated this past year, and rightfully so. They expected earnings to decline. They expected stickiness on inflation. The number one surprise for most people was that inflation came down as sharp as it already has. That really shouldn't have been a surprise when you had quantitative tightening plus all the hikes that went through. Now, granted, the Fed did add a lot of liquidity to the program to the markets itself. That helped grease the train tracks. But overall, what we've noticed is this. The bears ultimately go away for a while. They come back after you start to see some of consternation in some of the economic data. Europe could surprise to the downside. We don't know what China's growth rate is going to be, and that could be exported to the United States. So we're still going to grow below trend, and everyone's happy right now, and the drumbeat of soft landing is there. But as soon as you get some bumpiness, the market will pull back a little bit, probably late January, early February, and we think that that is a buying opportunity because it's all about earnings next year.
Chris, I got to say, I knew what you were going to say before you said it, because that's what everyone's saying. In January, we're going to get turbulence and buy the dip. And so at a certain point, this really is the exact same setup that we had this year, which was when you get a decline, buy the dip. We didn't really get a decline. We did a little bit, and people just came in gangbusters. Is this buy the dip going to be the broadening out that we see now? Is this basically the playbook for next year, just a little bit premature?
Yeah, so the bulls are beating the drum on the mega tech still. In some cases, that makes sense because that's the area of healthiest balance sheets, high quality. But the question is going to become, how much can they surprise above the earnings expectations? But the broadening out of the market is the one area that some are now starting to warm up to. They've been left for dead. Much of the rest of the market, particularly small caps and value overall, we think the next story, beginning already this past month, carrying into next year, for the next 5 years, the leadership are those areas, predominantly because of their underpriced movement versus the large quality, high quality area of the market, not just this past year, but over the past quite a few number of years. Last but not least, I'd say this, Lisa, those bears in terms of what they're looking at right now, they're looking at the what could be versus the what is. And ultimately, when that conclusion doesn't come through about what could be, stickiness or resumption of inflation, or much lower, maybe the negative leading economic indicators indicate lower growth, negative growth. That's what could be versus what is and what the data is telling us.
Chris, you mentioned the small caps. We've started to see that participation in the last few months. Small caps started to do well. The banks have absolutely ripped. There's one area of the stock market that hasn't participated. It's been left for dead. It's been the energy stocks. The energy names, as we've seen this rally play out, double-digit percentage point gains on the S&P 500. Energy's negative on the S&P, Chris. What's behind that, and what changes that story, if at all, into next year?
Yeah, Jonathan, and this is in the face of basically a year's worth of gains in a month and a half. If you really think about the broad market itself, small caps, the rest of the market outside the Magnificent Seven rallied over 12, 13% from the flatline level, and they've actually outperformed. But the one sector, as you said, energy, high free cash flow, actually better balance sheets than people think. I think there's a growth worry there for the energy sector. We've been overweight. The energy sector has not worked this year. We expect that angle in terms of investors looking for free cash flow again to start to come in. But it's all about the oil price right now. It's weakness in Europe. It's the below trend growth in the U.S. It's a lot of stories of a cloud hanging over what traditionally would be an area that you would hunt for, particularly when financials are working. You would think that some of the other areas like energy would. But right now it's pushed off the blotter. It's not on the buying blotter of a lot of the asset managers, and they're waiting for signs that oil prices are going to come back up again.
Chris, when you talk with the clients, how willing are they to actually deploy cash right now? How much are they feeling the holiday season of bullishness?
Just 2 months ago, it was all about what's around the corner to actually thwart any extra rally. Now it's all about, okay, where should I be as it relates to the market? Not significant enthusiasm because the geopolitical curve and volatility is still there, as you talked about before in the Red Sea. But ultimately, heading into next year, the common question is always, how should we be positioned? Now it's about how much and when should I be adding to areas of equities and longer duration fixed income. We talked about it in the summer. We talked about it again in the fall. No one throws up a flare gun. No one rings a bell when that's going to happen.
Yeah.
There's always a surprise that comes in. That surprise came with the Fed pivot, particularly Powell. We expect a couple more surprises to the upside early next year.
The psychology of markets are just phenomenal. Chris Heisey. Chris, thank you, sir. Enjoy the Christmas break of Merrill Bank of America Private Bank. So rates get to 5. You don't want to buy 5 because you think we're going to get 6. Rates drop to 4. You want to buy 4 because you're worried it's going to 3. That's how financial markets work. The psychology of them all the time. It just never ceases to amaze me. Just every single time I just sit here, I'm just like, yeah, okay, here we go again.
Well, it's sort of, what do you say? It's the only place where when something goes on sale, you don't want to buy it,
Yeah.
but when it gets more expensive, you want to race into it. It is shocking. How do you follow the herd at a time where the herd has won as soon as they get going? And what it took to sort of, key off the herd was the shotgun from Fed Chair Jay Powell saying, let's go.
Well, the herd was already running.
Fair point.
Got to be clear about that, right? The herd was already running.
True,
He's
yeah.
like, keep going,
Yeah.
keep going. 10-year, 390. If you're just joining us, welcome to the program. The S&P 500 positive here by 0.2%. Yield to lower by 3 basis points, 390.14. Allow me to frame the next 60 minutes on Bloomberg TV. You do not want to miss it. On the Suez Canal, on the Red Sea, and the traffic grinding to a halt, Ellen Wald of the Atlantic Council joining us very shortly. Then you're going to hear from Richard Clarida, the former Fed Vice Chairman and PIMCO Global Economic Advisor, in about 15 minutes' time. Then a little bit later, the Bank of America boss himself, Brian Moynihan. Don't miss that. And to top things off, as we anticipate the opening bell in about an hour and 17 minutes, we'll catch up with Mohammed Al-Arian to weigh in on what's been happening with the Fed speak of the last week.
It's an awesome lineup to give us a little bit more clarity. And I really would like honest talk about whether people are just as confused as we are about why there has been maybe a cleanup act among some some existing Fed officials at the same time that it seemed pretty clear what Fed Chair Jay Powell was doing and saying.
I just don't like the gaslighting. Just don't tell me I didn't hear what I heard on Wednesday, okay? And it was very different to what I heard 12 days previously. Very, very different.
The shades of gray that you're trying to create around this, it was not gray on Wednesday.
It was very black and white.
It was.
On Wednesday, without a doubt. Equities right now on the S&P positive by 0.2% from New York City. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The Maritime Task Force, to the degree that it can provide security for tankers in the region, might not eliminate the risk premium, but it could potentially keep it from rising. The supply cushion that you get from spare capacity from OPEC producers is usually something else that can come to the rescue. But in this case, that supply cushion is less available. We may see more risk showing up in price perceptions as we go forward. But yeah, we've been sleeping through some very serious potential supply risks for some time.
We're wide awake now, so let's talk about it. Joining us right now from the Atlantic Council is Ellen Wald. Ellen, this is a big, big story. Traffic going through the Suez Canal, the Red Sea, grinding to a halt. Can you walk us through the additional time that's required if you can't go through there and you need to go around the southern tip of Africa? What are we talking about here?
Yeah, it seems that we're talking about an additional 12 to 14 days of travel time to go around Africa. But that's not the only issue here. We're also talking about increased fuel for ships, a longer trip for the crews on board. It's going to cost more. They're going to emit more carbon. And so this isn't just, it's not safe or the Suez Canal is closed. We've had that before. This is a very significant journey. And it's particularly important right now because it used to be that Europe was getting a lot of its oil from Russia. That's not happening now, and it's relying a lot more on oil from the Middle East. And so if that oil can't go through the Suez Canal, then now we're talking an extra 12 to 14-day trip around Africa. And it also cuts out the Sumed pipeline because that pipeline is accessible. Also, you have to go through the Red Sea to access that pipeline as well. So essentially only you can get Saudi oil if it leaves the west coast of Saudi Arabia, which isn't a place where that much oil leaves Saudi Arabia. That can get to the Suez Canal or the Sumed pipeline without threat of Houthi activity. But otherwise, everybody else is stuck.
So if this was 2021, this would be dreadful. 2022, chaos. We'd be talking about higher prices and inflation spiraling out of control. In 2023, it just feels like supply chains are in a better place. And can you describe them? Are we in a better place?
Yeah, we're definitely in a better place. We're not going to see oil shortages. We're not going to see gas lines. During the Suez Canal crisis in 1956, that's what we saw when the Suez Canal was closed. We also didn't have at that time the very large crude carrier, which were these massive crude oil carriers, which they basically invented in order to take crude oil around Africa so that they could get enough to Europe. So we've got that now. So we're not talking devastation, but we are talking about increased time at a time when we've already got increased time to get oil shipments to Europe, and we're talking about increased costs.
Are you surprised that we haven't seen more of a pop in oil prices as a result, Ellen?
I'm not that surprised because this is something that's been going on for a while, and it's only recently, I think, escalated to the point where tankers and shipping companies that are not directly connected with any kind of Israeli interests are getting concerned and are making moves. So I think that the market has kind of been anticipating this for a bit of time. And then you've also got these overall kind of economic issues waiting on the market. I think that maybe they should be more concerned, especially because the idea that suddenly the U.S. Defense Secretary is only now setting up a commission to deal with this, that doesn't bode well.
And there are questions around what that commission can actually do, what they are willing to do, and what exactly the conversations are between the U.S. and Riyadh, for example, which might have more influence over the Houthis than, say, Canada. So how much, from your perspective, do you think that the right people are involved in these conversations? And do you have a sense of what the potential allies in the region might be willing and able to do?
I think that Riyadh would love nothing more than a green light from the United States to just bomb the heck out of the Houthis in Yemen. I don't think they're going to get that. I think the real issue here is where the Houthis getting this technology and these drones to buzz these ships and cause these issues, and that's the answer to that is Iran. And when you look at the likelihood of maybe a U.S.-Iranian confrontation over this, that's not something I think the U.S. is willing to risk. So the question is really, what kind of show of force is the United States and potentially an international coalition? Because safe passage in the seas, essentially freedom of the seas, is an international issue. This is not just a U.S. issue or a U.S.-British issue. This is really an international issue that China should be concerned about, Korea. I mean, we've got everyone should be much more concerned about this than they are. But the question is, who's going to actually put the muscle where it needs to be? And I'm not sure that we're seeing willingness to do that.
You touched on potential losers. I believe you mentioned European importers. Can we talk about winners? Who wins from this situation, Ellen?
Africa. I'm sure that South Africa is absolutely thrilled to see lots of increased traffic at its ports. In an extra, 12 to 14-day trip, sailors are going to want to stop. They're going to want to, have a break. They're going to want to go, on land. And so I think Africa is definitely a winner here because they're seeing a lot more traffic, and that means they can charge for it. I do think that Egypt is a huge loser here that really can't be overlooked, because if we're seeing a lot less traffic in the Suez Canal, they're losing money over this, and a lot of money.
And just to finish on prices, oil versus gas, is it a bigger issue for one versus the other, or the same?
I don't think so, because also when we talk about oil going through the Suez Canal, we often talk about it in terms of petroleum products overall. We're not really differentiating between crude oil and products here. So I think it's all tied in.
Ellen, thank you. Appreciate the update. Want to watch a developing story over the last week for sure. Ellen Wald there at the Atlantic Council, and lots of people weighing in. Lisa mentioned Andrew Honhorst, the city. I'll share that quote with you again. The effective closure of the Suez Canal trade route is a new upside risk to goods inflation. Lisa, just as you get comfortable with goods disinflation, this one happens.
The lack of clarity around just how much of an inflationary impulse, though, I think we're going to have to be parsing through for a while. You raised this good point. If it were in 2021, or even 2020 or 2022, it would have been much more challenging. But now that supply chains are up and running, maybe it's less disruptive. It doesn't feel like it's being priced in all that much, though. And Kevin Book was really adamant about that there could be more upside pressure on energy prices. But I do wonder if it's beyond that, if it is also goods, if it takes an extra 2 weeks to get something, and it has higher insurance costs, and there's the fuel cost, and there's the labor cost. I don't think it's going to be the companies paying for it.
I won't use the T word. Okay, maybe I will use the T word.
Come on, go for it.
Transitory?
Yeah.
How transitory would an episode like this ultimately be? And is it something that central bankers even need to be focused on? Developments of the last week.
They never are until they are, right? This is the same thing with oil prices. Oil prices are transitory. They come and they go, but they influence people's sentiment. They influence exactly what the price of different goods are, the price of airline tickets, et cetera. So, at a certain point on the margins, if you get goods reinflation at the same time that services inflation is sticky, well, that's a bit more problematic.
Then we're not talking 6 rate cuts that are currently being discussed in financial markets, no?
I mean, that's part of the issue, that people are starting to talk about the reinflation kind of risk. But right now, I don't know. They're going to worry about that in January, not right now.
Here's your lineup for the next hour on Bloomberg TV. Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Monica DeSenza of JP Morgan. Matt Miskin of John Hancock. And we will catch up with Mr. John Stolfus himself, the biggest bull on Wall Street out of Oppenheimer, and why, Lisa, he's so bullish and everyone else is joining him after what we've seen in the last week.
To say he's the biggest bull right now doesn't really feel even fair, considering that he's almost consensus at this point. What's his call, 5,200?
Something like that, but not highly dependent on rate cuts, which is what makes it somewhat original. And it was up there above 5,000 before everyone else started to really join in. And he's been right this year. Let's be clear about that. He's been right this year, and he's looking for more of the same into next year.
And the fact that it's not because of rate cuts really speaks to this feeling that profits will continue to be robust. And we heard that, even people bullish, even with a recession. At some point, a soft recession.
A soft recession. What is this? What is a nice recession? What is that? What does that even mean?
You know, a little bit of negative growth, but it doesn't really feel that way. And the labor market kind of remains intact, and it's just kind of, you know.
Doesn't feel that way for who? For markets.
But this is the issue. People are feeling it.
Exactly.
Individuals are feeling it. Small businesses are feeling it. And that, I think, is part of the dissonance between overall general composite data that shows good news and what people are feeling, which has consistently been less than that.
That's your lineup for the next hour. For the next 10 minutes, don't miss Lisa's conversation with the former Fed Vice Chair, Richard Clarida, and David Weston sitting down with the Bank of America boss, Brian Moynihan. All of that coming up in the next 60 minutes or so. Equity futures on the S&P 500 positive here by 0.2% from New York City this morning. Good morning.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. This is Bloomberg Surveillance, about an hour to the opening bell with another lift to the markets after the longest winning streak to the S&P going back to 2017, reaching all-time highs on the NASDAQ 100. The S&P bumping up against them, up almost 0.25%. It's like deja vu all over again with yesterday morning at this exact same time, although this time we're above 4,800 on the S&P, 4,803. We're seeing yields lower, inflect lower yet again, 3.89% in the wake of a lot of discussion around the potential for rate cuts, and crude off just 0.25% after yesterday's pop on the heels of some of the disruption that we're hearing about with the Suez Canal and the Red Sea being disrupted, the shipping channels there. I do want to bring to you some breaking news. We are getting some economic data. Housing starts came in higher than expected. This, again, comes after mortgage rates came down. We're seeing that, and actually an inflection upward in home builder sentiment yesterday for the first time since August. 1.56 million housing starts. The expectation was for 1.36 million. That is up significantly from the prior month. And building permits coming in pretty much in line, 1.46 million. What you can see is, again, the sense of optimism as people look out ahead to the fact that we do have a constrained housing supply, and we are not seeing necessarily some of the existing homes come back on the market. Mortgage rates have fallen from north of 8% to about 7%, leading some people to feel a bit more optimistic about the pricing. Not seeing an incredible amount of reaction in markets, but again, just another node of positive data, even amid the disinflation. A little pop to your yields, but nothing significant as people look toward the inflationary data that comes later this week. This is a conversation that, to me, caps off one of the most fascinating periods of Fed history and economic history that I've ever seen. Rich Clarida, former Fed vice chair, as well as Columbia University professor and PIMCO global economic advisor, as well as renowned singer. Rich Clarida, thank you so much for being here.
Hey, Lisa.
In person. I just want to start with what you make of the past week, Fed Chair Powell's comments and the market's reaction.
Well, the chair's comments took me by surprise, he had a difficult mission because it's the last meeting of the year. It's natural to look ahead. But yes, I thought both the press conference and the FOMC statement were more dovish than I expected. You know, there is a soft landing base case. We're all hoping for it. And I think the markets are really focused on that. He didn't say mission accomplished. I'm not sure if he thinks mission accomplished, but that's being interpreted that way. And of course, as you've mentioned on air, we've had a little bit of pushback recently. So we're all now trying to assess, you know, what message they would like to deliver.
Well, that's exactly what I wanted to ask you. What do you make of the pushback?
Well, I think the delicate challenge, and we've discussed this on the show in the past, is a tug of war between their guidance and market pricing. You know, part of the reason, Lisa, inflation is expected to come down next year to 2 point something is because financial conditions have tightened. Well, as the markets think mission accomplished and rate cuts, 6 cuts are coming in next year, that will ease conditions. That makes it less likely that inflation comes down. So it's a tricky point right now for the Fed.
Do you think that Fed Chair Powell made a mistake?
I don't think so. I think he was reflecting his committee, and I think in the press conference sometimes chairs can sort of distance themselves, and I think he was embracing the baseline view. But there is a risk case as well, and I think perhaps some of the pushback is to remind folks about those other scenarios.
Mary Daly, in a Wall Street Journal discussion yesterday, came out and said even if the Fed cuts rates by 3 times next year, that the Fed's benchmark rate will still be quite restrictive, even if in that scenario. And then she wanted to say we have to be forward-looking and make sure that we don't give people price stability but take away jobs. Is this a new emphasis for the Fed?
Well, Lisa, I think at the margin it is, because I think inflation was so high for so long. I think the Fed effectively had a single mandate for a couple of years. We got to get inflation lower. The Fed, of course, has a dual mandate, but I do think, and I, of course, work closely with Mary, I'm a big fan of hers, I do think the issue is that the committee itself emphasizes financial conditions. Indeed, financial conditions made an appearance in the November statement and reappeared in December. It is true that one element is the real funds rate, but other financial conditions are easing, which, as we said, makes it less likely that inflation does come down.
Which raises this question about whether you were right. the 2-point-something kind of view of inflation is kind of what the Fed is embracing right now in order not to jeopardize the labor market. Is that what your sense is?
Well, I've always thought that 2-point-something would be the point at which they start to think about cutting. So that is playing out in their projection. I do believe down to the individual, there are 19 of them, they all want inflation to get to 2. And I do agree with them that if they hold off cutting rates at all until inflation gets to 2, they're probably going to overshoot. But the timing is delicate, and I think there is a risk case on both sides. But I do think they are emphasizing now the dual mandate more than they have been.
Do you think it's because they're seeing something that other people aren't, or they're at least emphasizing in their own data some of the weakness that maybe is overlooked by people who are piling into the market?
I'm not really sure of that. I think it's important for them, the Fed was criticized a lot in 2021 and 2022 for being behind the curve. I think it's appropriate to step back and acknowledge the progress in disinflation. And I think they're seeing that, but I think there's still a ways to go. And I think in particular, the labor market may require more adjustment than they're factoring in. Sorry.
No, it's all right. I'll let you catch your breath. It's a confusing moment for all of us. And I'm wondering if you think it helps or hurts the cause to see the Fed come out, Fed Chair Jay Powell with one message, and then Austin Goolsbee saying, you guys, I'm surprised by your reaction, and hearing from John Williams saying, we're not really talking about rate cuts.
That's not something you'd like to see coming out of a meeting. I think the market reaction, easing financial conditions, is something that they are trying to push back against. I don't know how successful they can be, however.
Do you think that easing in financial conditions does have ultimately an inflationary impact right now?
Well, to the same extent that if you tighten financial conditions, it lowers inflation. If they're eased on a sustainable basis, credit spreads are tight, borrowing costs are lower, valuations are up. At the margin, it supports demand. And if you think there's a demand piece to inflation, then yes.
So right now, do you think that it is potentially concerning and counter to what the Fed is looking for, given the all-in feeling? And frankly, I mean, we just heard this morning, the Fed shot the bears. The Fed wants to make people happy. I was bearish, but now I'm really bullish. I mean, is this a positive thing?
Well, I'm very convinced that the Powell Fed will do what it takes. I think that the communications challenges, which were substantial in 2023, may be even more substantial in 2024.
There's been speculation from a number of guests that there is a political element to this, that the calendar is tricky for the Federal Reserve, considering that heading into November, everything is going to be really politicized. Yeah. Do you buy any of that argument that would encourage them to make a move earlier in the year?
Look, the history shows, in fact, I checked before I came on air, the Fed has actually adjusted rates in most presidential election years. In fact, they cut rates in '92 and cut rates in '08, although for other reasons, and they've hiked rates as well in election years. So historically, the Fed doesn't let the political calendar dictate the outcome. At the margin, could it influence timing, say, between a June move and a September move? I'm not sure, but I think that the number of rate adjustments we get next year will be the adjustments that the committee thinks is appropriate given the economy.
Given that we are talking about the politicization, do you think that this jeopardizes some of the credibility of the Fed, given that so many people have come on here and speculated, and we don't have any ability to basically know or not know, but is there some other consequence of just that speculation?
I really don't think so, Lisa. In the end, the Fed will be judged by returning to price stability and ideally doing so at minimal cost to the labor market. And so I think the Fed's credibility in the end will rise and fall with delivering price stability.
When you talk about the potential for a reacceleration of inflation and a stickiness, do you see that coming through the services sector in a material way? Which areas of the economy could we see a more material reignition?
Yeah, so I think I think exactly. So I think goods prices are now falling. So we've had goods disinflation, deflation. The service sector typically lags behind. I would also say I think where the rubber will hit the road, Lisa, is in the labor market. So we've had a substantial adjustment in the labor market without any rise in unemployment, and that is great. I will say my good friend and former colleague Chris Waller nailed that back in the summer of 2022. So that's wonderful. I do think, however, that you cannot have 2% price inflation target if wages are going up 4 or 5%, which is where we are now. So I think I would be, if I were there, I'd be looking at the labor market adjustment as well as the services sector as well. You know, one of the measures, which is core services ex housing, has basically not adjusted at all in the last several months, so still elevated.
A lot of people are talking about how the economic data has been really positive and how the Fed has been doing a good job and how we have seen unemployment stay low even with inflation coming down. Why do you think people feel so bad?
Well, I think there's a distinction, and it's certainly one I've thought about and written about. Economists tend to focus on inflation. That's the change in prices. But individuals in the economy tend to think about the level of prices. So even if inflation returns to 2%, the level of things, going to the grocery store, going to the movies, rent on your apartment, those numbers are all, a lot higher than they were 4 years ago. So I think when inflation's low and stable, we tend to ignore that. But when we've had a big move in the level of prices, I think it does create more concern among households than you may infer just by looking at the inflation data.
I want to ask you, though, also about the housing market. You mentioned rents being higher. We just got housing starts and building permits come in higher than expected. We do see some of the Treasury rally pare back, which is what you would expect. Does the high price of homes, in addition to the lack of any volumes, also create some sort of real dampening effect to sentiment?
Well, I think the high valuation for homes obviously makes the people who own homes happier, but there's a distributional consequence, especially for younger parts of the population, folks in their 20s and 30s who have not yet acquired that first home, and whatever they thought about the cost of ownership 3 or 4 years ago, it's a lot higher. But there's a huge wealth effect, positive wealth effect for folks who own homes. Presumably they're happy about that.
Well, but it raises this question about what this does longer term to the inflation dynamic, but also to sentiment, particularly for younger individuals who haven't gotten in.
Yeah, well, it does. And I think that this is an unusual period, Lisa, in the sense that because so many folks refinanced into low-rate mortgages in the prior decade, the Fed, including when I was there, was doing QE to support the mortgage market. And because these are 15 and 30-year fixed-rate mortgages, it is having this effect on supply that may be with us for a while.
We're here with Richard Clarida of PIMCO, formerly Fed Vice Chair. We are going to be having a conversation with my colleague David Weston, with Brian Moynihan of Bank of America. And I do want to get your take, Rich, on whether you are seeing the stability in banks as one reason why a soft landing can materialize, right? Is that sort of one tailwind that to a lot of this rally that was not there, say, in March?
Lisa, absolutely. You know, the global financial crisis triggered a major rethink of the way that we regulate and supervise banks in the U.S. as a whole. If you look at all the banks, they have lots of capital, lots of liquidity. And indeed, in 2020, when we were going through the dark days of the pandemic, banks were a source of stability and increasing lending. So absolutely, I do think it's an important reason to think of the banking system as supporting the economy and not being a headwind.
Rich Clarida, thank you so much for taking the time, as always. Wonderful
Lisa.
to get your insights right now. If you are just joining the program, we do see a bit of a decline from earlier highs in the S&P futures, now up about less than 0.2% after better than expected housing data. Euro just a touch higher, 109.57. 10-year yields 3.91%. Right now, I am so pleased to say my colleague David Weston joined over with Bank of America Chair and CEO Brian Moynihan. David?
For our Bloomberg radio and television audiences worldwide, we are joined now by Brian Moynihan. He is Chair and CEO of Bank of America. Brian, thank you so much for joining us here at the end of the year.
David, it's great to have you here, and happy holidays. And you can see our teammates out there working away on the trading floor here at One Bryant Park.
Yeah, and we're going to go back to the trading floor because you had quite a year in trading. But first, talk about the year overall. There have been a fair number of surprises, given what some people expected at the beginning of the year. Certainly, the stock market has done very, very well. We had more interest rate hikes than we thought we would have. Unemployment has really held down pretty well. And we didn't have that recession so many people thought we would. Now, I must say, when I talked to you throughout the year, you kept saying the economy looks pretty strong. Some of your compatriots were saying, oh, no, hurricanes and tornadoes and things like that. So how'd you get it right?
Well, we just try to follow the data, and I think there were unexpected events. There are unexpected events in every year, you know. And so whether it was the regional banking crisis early on in the year, or whether it was another, the Hamas attack on Israel on October 7th, whether it was escalation, a continuation in Ukraine, whether it's the tensions in China, these are all things that happen. They go on all the time, but what we look at is what goes on in our core customer base, and we try to talk about what is going on as opposed to what could go on, and plan for what could go on. And that's been relatively strong. And our team, the spending continues even today at about 4 to 5% over last year, half the growth rate of 22 to 21, showing the consumer has slowed down, consistent with inflation getting under control, consistent with the Fed using the rate structure to choke off some of the activity, and it's happened. But overall, it's been a decent year, and the economy's grown, unemployment stayed low, and the bank's done very well.
Let's talk about the consumer. You are the largest consumer banking operation in the country. We are in the middle, toward the end now, the holiday season. What are you seeing there? I knew until now it was holding up pretty well. Where is it right now, the consumer, as of today?
Sure. So if you looked at it November of 23 over November of 22, and this is across about $300 or $400 billion a month of activity, customers spending money out of their accounts, that was up about 4.5%. So far in December, it's holding about the same. And again, that's about half the rate it was growing at last year at this time versus the year prior. And that's because the overall activity is slowing down. What's been interesting is it's broadened out to all things. There were these periodic things since the pandemic. First, people holed up and bought stuff for their house. Then they started to go out and travel some. Then they went to restaurants. Then they had another set of travel, different kind of travel, international travel. And then they got to concerts and things. That's all through the system. And now you see it spending kind of evenly across, retail stores are doing fine. Online sales are strong. They're all up, 2-3%, flattish, 2-4%, depending on what it is. So everything's kind of normalized for the U.S. consumer and how they're spending money. They are in very good shape. They have money in their accounts. They're employed, and the wages are growing. It doesn't mean inflation didn't affect certain parts of the American public hard, but in general, when the unemployment rate's still in the mid-3s to mid-to-upper 3s, that is a very strong place for the consumer, but it has slowed down.
You say they're in good shape. That's what I was going to ask you. They're spending money. Can they afford it? What are you seeing in terms of their bank balances? I believe those have come down some. How fast are they coming down?
So it's a little bit of two different types of customers. For consumers that had a lot of excess cash, of course, when the rate they could get on that cash went from 25 basis points to 5% plus, guess what it did? It moved the market. So the very upper balances of consumer and our wealth management customers moved the market. But if you look at the consumers that the accounts are more the money coming in and out, they're still sitting with multiples of what they had pre-pandemic. So a cohort of consumers that had between $2,000 and $5,000 in their accounts pre-pandemic, average about $3,200. They're now still sitting with about $13,000 in their accounts. It has come down from a peak of 13.4 down to about 12.8. So it's come down a bit, but still much higher than it was before. And that's due to all the stimulus and stuff, and then holding on to that. Where they go next is going to be a more interesting question. They've slowed down their spending because things got more expensive. They slowed down their spending because they got a little bit more worried about their job. They slowed down their spending because the rates on car loans or all the things became more expensive. But they're still spending more than they did last year, and that's a decent setup for a soft landing.
Are you seeing any softness in consumer credit? I mean, are you seeing balances go up, delinquencies go up?
Well, balances have gone up in credit cards back to where they were pre-pandemic for us and the industry. And people are like, oh my gosh, and they're up above that even. But if you adjust it for the size of the economy, they're actually still down. And so the consumer capacity to borrow is strong. Mortgages are all locked in at low rates. That the best asset for a lot of households is actually their low interest cost liability. It's mixing two different things on the balance sheet, but the reality is a 3% mortgage is an asset for people right now because it means their payments haven't moved. So that's good news. The home equity borrowings are down for us from 30 billion to 20-some billion. That means that they're not using that equity in their house, and there's more equity in their house. On the credit cards, the delinquencies are really consistent with the 19, and everybody says, well, it's back to 19. 19 was one of the best credit years in the company's history and the industry's credit history. So that's a very strong place. And so we feel good about consumer credit. And as long as the employment levels stay there, it's a little hard to believe that you'd have it. Now, lower FICO scores, you hear people talk about a little more noise, but the general consumer is basically a prime borrower, and they're doing fine.
What about the commercial side? You're very big in middle market, small and medium-sized enterprises. Is there loan demand? What's the sentiment there?
So, you know, if you think about the consumer, we keep growing customers, keep growing households, keep growing this company. If you think about on the commercial, we keep growing customers, you know, more logos, as our teammates call it, you know, companies that we do business with, a record number this year. The thing about it is they're not using our lines as much. So the loan balance growth on the commercial side has been a little bit sluggish, a little bit flattish. Looks like it'll bounce around in low single digits this quarter. Now, why is that happening? Line usage before the pandemic for middle market clients was 40%, dropped to 30%, got back up to 36%, and it fell a couple hundred basis points. Why would companies borrow less at this point? They're worried about final demand. It's also a lot more expensive. So the Fed is having the impact, which is a loan that was like 3% to 4% is now 7 to 8%. People think about using it. So the line usage is down, meaning that they're not being as aggressive buying equipment or hiring people or extending inventories, mostly because they're worried about the economy slowing down. And when we say a soft landing, it doesn't mean the economy goes into recession. It says no, but what our team is saying, Candace Browning, Platinum Research Team, is that we're slowing from almost a 4 to 5% growth rate to 1% growth rate is still a major slowdown, and the business community is wrestling with that right now, trying to get that balance right.
One of the big surprises this year came toward the end of the year with the Fed decision and then the news conference of Jay Powell that really signaled, at least to most of us, yeah, they're really seriously considering rate cuts. It looks like they're coming next year. Were you surprised, and why do you think they did it? Do you think they're seeing data about the economy that it's slowing faster than we appreciate?
Yeah, so let's talk about what our economists tell me, and we could feed it in. We have the #1 research team in the business, and Candace and the team do a great job. They just shifted yesterday, literally, and they moved to more rate cuts in 24. But the real key was, what do they see in the economy? And they basically have moved from a 0.5% growth rate annualized for the first 3 quarters of next year up above 1%. So they've softened their soft landing, let's just say that. And by doing that, they've said when the Fed is seeing inflation slow as fast as it is, they basically think we get down to low 2s in inflation by the year and next year, 24, and it carries into 25. The Fed needs to bring the rate structure down. They're saying basically 200 basis points of rate cuts, 100 next year and 125, which still leaves you at 3.25, 3.5. Now, the last time we were fundamentally at that rate structure was it was 18 years ago by the time we get there. So we've had a long stretch of very low rates, except for what happened very recently. And so that fueled a lot of activity. And now the rate structure can be fundamentally higher. It's more structurally sound. And the Fed it's not really pivoted to say we got to normalize this because we're seeing the economy and the inflation come in. Not done yet, but all indications are doing there. And everything we can see that consumer spending is consistent with a 2% inflation economy. That level of spending growth in our customers was where it was in 17, 18, 19, when the Fed raised rates to bring the economy back in sync.
So the stock market did pretty well this year up until that Fed decision, and then it's off to the races since then. Your trading desk has done particularly well this year. To give us a sense of where it is right now, are you going to finish the year as strongly as you have been going this quarter so far?
Well, you can, from your lips to their ears, so they've got a few weeks left. No, they're doing fine. We said that they'd be up year over year, which is kind of counter to the trend in the market. Jimmy DeMar and the team have done a great job. And what's been interesting, it's rounded out, and it's fixed income, it's equities, and it's much more consistent. I'm not quite sure it's exactly true, but they basically made money every single trading day this year. And so there's been volatility, there's been news, there's been this, and that's because they have a balance in the business in the way that goes through. We increased the size of the business 3 or 4 years ago under Tom Montag's leadership and Jimmy's leadership, and that's borne fruit, and they keep gaining market share, and they're doing a great job.
So I'm glad you raised that, because 3 or 4 years ago, I was here with you at Bank of America, and you said, you know what, you're going to have to devote more capital, more people into that business. You did it. You seem to be having success. Going forward, is there yet more capital that you're going to allocate into trading?
Yeah, as long as they can get the returns. You know, at the end of the day, our return on equity is 15% as a company. This business, because all the regulations and the capital is a little lower than that, but it's well above our cost of capital. As long as they can keep deploying it, we'll keep pushing capital because it's a great business and great format, and we're gaining market share, honestly, across the world. And it's a global business, so it can access a much deeper client base. The team's done a great job, so they'll keep getting more commitments consistent with them being able to get the returns on them.
One last one, Brian. Are you concerned at all that the market's maybe overreacting to what they heard from Chair Powell?
I think he's got this challenge that, you know, he was, the Fed in our own mission was late to cutting off inflation. Now he's been careful not to be late to stop cutting off inflation, and the market's going to ebb and flow. But I think people have to be a little careful. This is trading talk. This is, the 10-year moving around between, 390 and 450 and 470. It's not the real economy. The real economy is still heavily impacted by the overall rate level. It's very restrictive, and it's still coming through the system. Against that, we still have a lot of stimulus coming through the system.
Yeah.
The infrastructure bill, the CHIPS Act, the IRA, those are all still coming through the system. So that's a tug of war he's up against. But overall, we believe he's engineered a soft landing through the interest rate environment.
Brian, thank you so much. That's Brian Moynihan. He's chair and CEO of Bank of America. Back to you.
Thank you so much, David Weston. Wonderful work, as always, there with the CEO of Bank of America. Let's just get a quick look at markets that are fading just a bit after better-than-expected home building statistics coming in now just about 0.2%. Again, no drama. You can't dent this market when the Fed has shot the bears, according to Jason Trennard, and when the Fed wants to make people happy, according to Avery Sheffield. 48.03, looking at a bit of euro strength, even after some pretty negative numbers out of Germany with their business confidence, 109.61. 10-year yield still settling in about 2 basis points lower, 390. And looking at crude, really about flat, retracing some of the losses. A big question mark here about the attacks by Houthi militants on shipping containers as well as oil tankers going through the Suez Canal in the Red Sea. A question about what people will be willing to do, if anything, given the fact that the U.S. does not want to be involved in any kind of prolonged issue. What you are seeing across the board, though, is otherwise exuberance. 2-year yields also coming in dramatically since some of their near-term highs, just basically flat today, 4.44%. And in the credit space, we were just talking with Rich Clarida of PIMCO about the possibility of what rate cuts would look like and the stimulative nature of the rally that we've seen in markets. Right now, looking at investment-grade credit spreads about a percentage point over benchmark rates. Costs have come in. People are planning to borrow. Animal spirits revving back up. Is this a problem or is this warranted? Coming up on Bloomberg Television, Mohamed El-Arian, Bloomberg opinion columnist and Queens College, Cambridge president, in a conversation with Jonathan Ferro. You do not want to miss that. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The unstoppable rally continues. Live from New York City this morning. Good morning, good morning. Your S&P 500 positive by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Fed officials struggling to put a dent in this rally, shipping in the Red Sea grinding to a halt, and Apple just days away from a US watch ban. We begin with the big issue, conflicting messages.
We weren't talking about rate cuts at all.
Rate cuts are in the discussion. We're not promising rate cuts.
It's difficult when you've got the chair with a very, very dovish message and then members of the committee are walking it back.
You saw some pushback.
Fed speak push back on some of the moves in the market.
Folks coming out in the days after saying maybe people need to reconsider.
Saying that the markets are being a bit presumptuous.
The market's already well ahead of the Fed.
It has been an absolutely enormous rally here.
Bonds and stocks alike have trimmed the tree. They popped the champagne cork for New Year's. They booked a ticket for summer vacation.
Where did all the bears go? And I think we know. The Fed shot them.
Powell himself had the chance for pushback in his speech, and he didn't do it.
He has to be very careful. Fed officials were sort of paraded out and say, stop this and make sure you get the right message out.
The message for markets is, don't get ahead of yourself in expecting a huge number of rate cuts in the first half of 2024.
This market is getting ahead of itself. Let's have that conversation right now with Mohammed Al-Erin of Queen's College, Cambridge, with us in the studio here in New York City. Mohammed, great to catch up with you as well, sir. Let's start with this. We're stuck on Wednesday. Never mind the fact that it's Tuesday, we're still talking about Wednesday. What happened in that news conference with Chairman Powell last week?
Total confusion. And the fact that you start a show on Tuesday talking about confusion from last Wednesday is an indication of how absurd this whole situation is. John, the whole point of Fed communication is to do two things. One is to be transparent, and two is to enhance the power of forward policy guidance. Instead, Fed communication confuses people. Fed communication fuels moral hazard. How often did you hear the Fed put is back? And it erodes the credibility. I think we have a real problem with Fed communication, and the market is absolutely correct in trying to do two things. First, in trying to bully the Fed, because this Fed seems to be willing to be bullied. And secondly, to get carried away with this notion that the Fed put us back.
Let's go back to the comments from Chairman Powell in the news conference, Mohammed, and work through them together. Here was the quote. The question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now for the world, and also a discussion for us at our meeting today. Did you find that confusing, or the comments we've had since then confusing? Which one?
So, like everybody else, I think you put more emphasis on Chair Powell's comments, and that's what the market has done. If someone was with him that understood how the market would react, they would say to him, whoa, be really careful, because the way you're going to be heard may be different from how you want to be heard. You're going to be heard as opening the door wide open to a major rally in both fixed income and in equities. You know, in the old days, you had people like Kevin Walsh, who would be in touch with the markets, who understood how the Fed would be heard, and who was a moderating voice in terms of let's ask the question, not what do we want to say, but how will we be heard. We don't have that. And John, this other confusion, you have now two-pronged communication reaction. One is to walk back what he said, and the other one is to explain what he said, right? You can't do both at the same time. We've got to decide, are we walking it back or are we explaining it? Now we're getting both.
So we've had plenty of pushback, not just from Fed officials, but from people writing columns, including yourself, Mohammed. Bill Dudley, former New York Fed president, said this was a big gamble, this apparent pivot. You've said the market shouldn't be being bullied, or rather, the market shouldn't bully the Fed. Now, can you explain to me just that headline on the market bullying the Fed? How is the market bullying the Fed?
So what the market has done, and we saw it in January of 2019, we saw it happen in April of 2020, we saw it happen in November of 2021, is that every time the Fed goes towards the market, because there's a decoupling, the market runs away further from the Fed. And the market has understood that it can drag the Fed along. And that's got to stop, John, because we get overshoots, and then we've got to pay for the consequences of those overshoots later on.
In the piece in the Financial Times that you wrote earlier this week, there was a quote at the very top of the article. It read as follows: "It turns out that inflation was transitory after all." That's some of the language being used out there at the moment, Mohammed. Why is that the wrong conclusion?
Yeah, so I used that quote and then pushed back on it immediately, saying not only is it analytically incorrect, but it is dangerous. Why is it analytically incorrect? A transitory phenomenon is temporary, it is reversible, and therefore you look through it. You don't change your behavior. Massive behavioral changes have resulted over the last few years from inflation that was too high, starting from the Fed itself having to tighten, but we've seen also the banking issues. We've seen what's happening to commercial real estate. There's been major changes. So to call inflation transitory after all is to ignore that the landscape has changed because of inflation. It's also dangerous, John, because it opens the door to this notion that we're going back to a rate structure that is very artificial. We're not. We're going to settle at a higher average level of yields than we did after the global financial crisis. And we shouldn't fuel this notion that we're going back to what followed the global financial crisis. We are living in a world of inflexible supply side. What's happening in the Red Sea is another illustration of that. And we've got to recognize that we're no longer in a world of insufficient demand. We live in a world of insufficient supply.
We'll get to the Red Sea and the Suez Canal a little bit later in the hour. Let's just pick out one part of the economy, Mohammed, together. Let's go to the labour market. Haven't we learned from this cycle so far that this labour market, the characteristics of it, aren't a threat to price pressure?
Yes, because the supply side has been responding. It took time, but it's lovely to see people going back into the labor force. Having said that, John, we're still in the middle innings of the labor market. So let's wait and see how that evolves. But the good news, and we should all be encouraging this, is that more people have entered the labor force.
You think it's wrong to assume that supply side-led improvement, rebalancing we've seen won't continue?
I think there's a real question about skill mismatches. There's a real question about how far you can increase labor force participation. My hope is that it will continue, but you need to wait and see.
So we've had massive easing in financial markets, financial conditions over the last 2 months, both in equities, credit, and also in the bond market as well. Yields aggressively lower. What's the price we're going to pay for that, do you think, the moves we've seen in just the last 2 months?
Yeah, I mean, first, the easing has been historic. Lisa put out a tweet before Chair Powell turbocharged this whole thing, showing that financial conditions were looser today than they were when the Fed started hiking. And then they've loosened significantly since then because of the way the market interpreted what Chair Powell has said. What's the risk, John? The risk is that they're loosening too quickly and too much, and that in itself will mean that the last mile of the inflation battle, which was complicated to begin with, gets even more complicated.
Why does it have to be complicated? We've heard from many people who think maybe the hard work is behind us. Jan Hatzius, Goldman Sachs, talked about that in his outlook for 2024. And I think we're hearing that from Fed officials as well. Yeah, perhaps this last mile doesn't have to be that difficult. Secretary Yellen even weighing in on it as well. Why do you disagree with them?
So first of all, it depends how you define the last mile. If you define the last mile how I would like them to define the last mile, which is de facto or implicitly target a high inflation rate, it doesn't need to be difficult. And if that's what their thinking is, I very much applaud that, because there's no need to sacrifice the real economy in order to get to an inflation target that's not suited for the world we live in today. So if that's the interpretation, then I'm with them. It doesn't need to be complicated. It doesn't need to create damage. If the interpretation is we're going to get to 2% without causing problems, I just don't see it. Look at the inflation dynamic. Look at what's happening. You would need service disinflation to massively accelerate because outright goods deflation is going to stop at some point. And it's very difficult to get service inflation down using interest rate policy alone.
So do you get the sense this Fed is accepting 2 point something for inflation and not 2.0?
I think they're heading that way, John. Yes, I do. I think they're heading their way. They're never going to say it, but I think they're recognizing, and the new emphasis you're starting to hear, and you heard it today from Mary Daly, the president of San Francisco Fed, saying basically we don't need to sacrifice the real side of the economy.
Heard that in that interview with the Wall Street Journal. Mohammed, stick with us. I'm pleased to say he's going to be with us through the hour. Your equity market open in about 20 minutes' time. Equity futures right now on the S&P positive by 0.1%. With some movers going into the open, let's say good morning to Abigail.
Good morning, John. Let's start out with the shares of Kenvue. This spin out from J&J popping by about 6%. This as a court ruled in the company's favor in a class action lawsuit related to Tylenol. Analysts, however, are saying that some caution may still be warranted because there could be a lengthy appeal process. Chewy up 4.5%. Jefferies initiates with a buy rating and a $27 price target, suggesting that some nice potential for price appreciation could be ahead. They're saying the company is positioned well for an inflation and a period of trading down in pet food. And then finally, Accenture, the technology consulting company, it maintained its fiscal year earnings forecast, but that's below the street for a stock that's up 28% year to date. Investors wanted more.
Abby, thank you. Coming up on this program, equities heading towards all-time highs.
I think equities have a ways to go, and I think you could see them test and challenge and surpass the old highs. That's always been our call.
That conversation up next.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
I think equities have a ways to go, and I think you could see them test and challenge and surpass the old highs. That's always been our call. Even if you do end up having a recession, markets always hit a new all-time high before they do that. So I think there's a much better risk return in equities right now than there is bonds, and that's different from a month ago.
The Fed just can't put a dent in this market rally. The S&P 500 heading towards all-time highs with an 8-week winning streak now a possibility. The Nasdaq hitting a record of its own on Monday for a second consecutive session. Bloomberg's Katie Greifeld joined us now for more. Morning, Katie.
Morning, John. Yeah, when it comes to the S&P 500, we are just inching and inching closer to that all-time high. To go through some of the numbers right now, the benchmark closed at 47.50 yesterday. Its record closing high is about 1% away at 47.96. That was reached in January 2022. So quite a while ago, but we're just a hair away here. And like you said, it's been a very consistent climb higher. 7 straight weeks of gains and a real broadening out. If you take a look at the sector breakdown over the past 2 months or so, real estate is at the top of the leaderboard with a 17.5% gain, closely followed by consumer discretionary, higher by nearly 15%, and then tech following in third place. And that's a real regime shift from much of 2023 when it felt like tech and AI optimism was really dragging the index higher against its will. But now, following that huge plunge in yields that we saw, growing conviction that the next move from the Fed will be a cut maybe sooner rather than later, it's those real rate-sensitive sectors that are shining. Even still, though, it's hard to fight the influence of mega-cap techs. Despite that improving breadth, you take a look at the S&P 500 equal weight index, it's still lagging the S&P 500 year to date, despite outperforming over the past 2 months. And while the S&P 500 just a whisker away from that all-time high, the equal weighted index still has a lot of ground to make up, John.
The S&P getting closer and closer. Katie, thank you for that. Michael Harnett over at Bank of America capturing this almost perfectly in a survey of global fund managers showing the most upbeat sentiment since January 2022. Investors expecting a Goldilocks environment in 2024, bolstered by expectations of Fed easing. Joining us now to discuss, John Hancock's Matt Miskin, JP Morgan's Monica DiCenzo, and Mohammed Al-Erin of Queen's College, Cambridge, still with us. Monica, I want to come straight to you. How expensive is that soft landing hope dream, that story for next year? How expensive is it now?
It's been funny to watch markets. You know, sitting here a year ago, everyone was so paranoid and scared about what they thought was going to be a recession that was a sure thing. And now fast forward, equities are up 20%, and now everyone's crippled because they think things are too bullish and they've missed it. And so for clients I work with, what's really expensive is to sit in cash and keep watching the next phase of this cycle. And so we've been really focused on how to get invested, make sure you're still meeting the goals that you've outlined, because sitting in cash is not going to do it.
Matt Miskin, what are you telling people?
Yeah, things have gotten expensive. And over the course of the year, we've gotten almost 20% of the return from multiple expansion. I wish that multiple expansion just could continue into next year, but it's going to be hard to do. We're at about almost 19 times. The July high was about 19.5. You know, Albert Einstein said that compound interest was the 7th wonder of the world, not multiple expansion. So we want to actually find places to get income into next year. We want to make sure we're compounding interest, staying invested. We have played the quality factor in the U.S. over the course of the year. That has done well for us. But frankly, we're looking to trim some risk into next year.
So Matt, speak to Monica's point about people feeling uncomfortable in cash. What do you say to clients that say, you may be right, but the alternative is worse?
So we're looking at locking in those rates for those clients, and we actually see more of a disinflationary environment into next year based on the housing data catching up from that lagged effect. And we actually think that the bond market is a better place to lock in higher rates for longer. I know that the bond market has priced in a lot of rate hikes in quick order here from the Fed pivot. But in our view, that's where you want to be for that kind of capital. On the equity side, we're just trying to find more defensive, higher quality businesses to be long-term investors. But frankly, earnings growth estimates look high, multiples look high. So we want to find cheaper parts of the market that offer us better return potential.
So Monica, based on that, you hear a lot of people saying high quality bonds are win-win. You get good income, and if, God forbid, we slip into recession, you'll get the price appreciation as well. What do you say to those people who say, from a risk-return perspective, high-quality bonds are a better place to be?
I think that's a fair assessment of the market. Again, the challenge is, what is the goal I'm trying to achieve through a cycle and long term? For most clients I work with, a 90% bond portfolio is not going to get you there. So it's about finding the right places, to Matt's point, to add risk in a thoughtful way. I'm not afraid of equities, but I do think you have to be eyes wide open. It's no longer just a beta trade. You have to pick some of your spots. One thing I would highlight, in spite of this rally, volatility is very low. People are getting nervous to add. if I were adding here, maybe I'd overlay with some hedges because I do have that bond portfolio throwing off some good income. I can buy a little insurance. And to me, that's probably a better balanced way to think about your risk than to be all bonds or all cash right now.
Can we talk about the correlation between bonds and equities at the moment, Monica? Is there any reason to believe that's going to change in the next few months?
I mean, I think it's a macro question, right? So it certainly could. And I think when you start to see these cuts play out, if they do play out, bonds will eventually look relatively less attractive. And maybe that's the world where if they can navigate the soft landing, then it's a green light again across the board for equities. But again, like many clients I work with are so scarred from what happened over the last couple of years when you had equities down and bonds down, that they're a little skittish. And so it's, again, about finding the right balance and being really thoughtful when you're leaning in, especially if you're someone today who didn't participate in this rally. It's going to be hard to get people over that line. And so we're just trying to find ways to, most importantly, move out of cash and take a little bit of risk again.
Matt, how do you answer the same question?
Well, one, I would say every time that the 60-40 portfolio is forecasted to be dead, it comes back alive. And November was one of the best months for a 60-40 portfolio in the last several decades. Now, it is all one big trade. It is, my colleague Emily Rowland came on and talked about the pivot party, and every asset class is invited to the pivot party. And so everything in a portfolio is going up. In our view, that is not sustainable. Different parts of a portfolio, different asset classes have different attributes. High quality bonds should not be acting like regional banks. They should be inversely related because the fundamentals dictate that. Eventually, we do think that comes into play into next year. Pivot parties are a late cycle phenomenon that usually do add risk, but then subsequent to that, the fundamentals, whether it's earnings or macro environment, becomes a bigger factor in time. We think that's the story of 2024.
Monica, you mentioned some of your clients still being scarred. Help us understand a puzzle. One of the asset classes that hasn't seen inflows in recent weeks, in fact, has continued to see outflows, is emerging markets. And that's despite a higher average quality, that's despite less leverage, that's despite a cleaner technical background. Are your clients simply too scarred to go back into more peripheral asset classes?
Yeah, I think there's no doubt there's a value argument to make for emerging markets, equity, and credit. The challenge, though, and I saw this coming out of COVID, people said, you know what, I'm scared about the world. I don't understand what's happening. And if I have to go back into risk assets, I'm more comfortable in the US, kind of what I know better, just feels a little bit safer. Now, doesn't mean that's the right answer. There's a psychology versus what we theoretically would all do from a market standpoint. For me, again, talking to clients, I just want them to add risk. I would love if they were more diversified because so many were very US focused, and you've seen real pockets of brightness across international markets. But my first and foremost goal is get out of cash, go a little out in the risk spectrum. If I can get you there, then yes, I would love to see you more diversified, but that's sort of the second iteration in most of the conversations I'm having.
Hey, Monica, appreciate the update, as always. Monica DiCenzo there, alongside Matt Miskin. Mohammed, let's build on that just a little bit. EM. I think it's a massive home bias right now here in the United States. Growth is okay, inflation's coming down, rate cuts seemingly are just around the corner. Why wouldn't you stay here? Why would you go abroad right now?
Because there's more value abroad. You've seen this in local currency, in EM. The asset class has been abandoned by quite a few investors. As I mentioned, speaking to Monica, it continues to suffer outflows when other asset classes have suffered inflows. I mean, we call it the everything rally, and EM has rallied, but it hasn't changed the technical dynamics. So I find it quite interesting. There's a lot of conversation going on. Is it structurally damaged? Is it the way EM is managed? But if you compare like for like, there's a valuation advantage that it isn't being exploited enough in EM.
We'll see if rate cuts are a catalyst for change, a change of attitudes towards emerging markets in the year to come. I'm pleased to say Mohammed's going to stick with us. Coming up on the program, the morning calls, and later, Oppenheimer's John Stolfus on why positivity at the end of the year should mean more good news next year. One of the biggest bulls on Wall Street around the opening bell. Your opening bell is 7 minutes away. Equity futures on the S&P, just about positive.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Minutes away from the opening bell. Outperformance again on the small caps. The Russell up by 0.75%. That's the price action. Here are some morning calls. Your first one from Bank of America, raising its price target on Costco to $7.40 from $6.55, seeing the company's value proposition as more attractive for consumers, adjusting to higher prices. Your second call from KeyBank, raising its price target on Uber and maintaining an overweight rating, citing stable trends in ride-sharing market share, intent to increase trip frequency, and food delivery adoption. That stock is just about unchanged. And finally, JMP Securities raising its price target on Lennar to 170, pointing to stellar fourth quarter earnings, thanks to a boost in deliveries. That stock is up by about 1.1%. Coming up on this program, Oppenheimer's John Stolfus on why he sees support for stocks heading into 2024. One of the biggest bulls on Wall Street is just around the corner. Your opening bell is up next.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
We are already on the longest weekly winning streak since November 2017, 7 weeks of it. Here we are week 8, and the rally just grinds on. Equity futures on the S&P up by 0.1%, on the Nasdaq up by 0.1%. Take a look at the Russell, the small caps up another 0.75%. There's your opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year this morning. Yields are lower by almost a basis point, 392.19. Remember the levels of late October through 5%, now south of 4. It's a move of more than 100 basis points lower. Equities rallying, bond markets rallying too. In the FX market, the euro shaking off some bad data, 109.67. Stronger euro against the weaker dollar. That currency pair positive by about 0.4%. Lots to talk about in the Middle East. Specifically, what's happening with the Suez Canal and the traffic going through the Red Sea and what it means for this commodity market. Crude up by 0.5%. WTI $72 and about 83 cents. About 35 seconds into the session, equities advancing by just 0.15% on the Nasdaq, up by 0.21% on the Nasdaq this morning. Record high after record high on the Nasdaq 100. Can we add to that in today's session? One stock to watch at the open is Kenvue, the Tylenol maker, scoring a legal victory with a court ruling in its favor in a class action lawsuit involving the drug. Abby has more. Hey, Abby.
Indeed, John. And the stock today is popping as a result, up more than 5%. Its best day in nearly 2 weeks. And this lawsuit has to do with, it alleges that Tylenol taken on a prenatal basis can cause autism and attention deficit disorder. On Monday, however, a federal judge granted the defendant's motion to exclude plaintiffs' expert opinions on whether that is in fact the case. JP Morgan analysts are saying that this is quote unquote a clean sweep for the defendants and that it quote unquote effectively collapses the plaintiff's case in the multi-district litigation. Other analysts, though, say that the possibility of a lawsuit dismissal, because Kenvue is saying that they are going to seek that the case is dismissed, reduces but does not eliminate the litigation risk, mainly because there could be a lengthy appeal process that could prolong uncertainty. On the year, John, this stock is now about flat from where it IPO'd this spring.
Up 5% this morning. Abby, thanks for that. Let's stick with pharma. Amgen upgraded to outperform at BMO Capital Markets because of its potential in the obesity drug space. Katie Greifeld on top of this one. Hey, Katie.
Hey, John. Well, when you mention obesity drugs, it's probably Novo Nordisk and Eli Lilly that come to mind. And that's actually at the core of BMO's Amgen upgrade. Taking a look at the actual note, analysts there saying that Amgen, quote, has unappreciated potential when it comes to the obesity drug market, and that the biotech's developing pipeline gives investors the opportunity to play in this space without paying the same premium that you'll find when it comes to Amgen's peers here. Now, as a result, BMO says that Amgen may be the 2024 value obesity play, which sounds a little bit like a curse given that value stocks can't seem to catch a break. Maybe Amgen will fare a little bit better here, but it's an important point. You take a look at shares, they're only about 5% higher in 2024. For context, you take a look at Novo Nordisk, currently sitting on 45% year-to-date gains. It's even more dramatic if you take a look at Eli Lilly, currently up about 58% year-to-date. So even a catch-up trade would be pretty powerful when it comes to Amgen. You take a look at shares, only about 1% higher right now, though, John.
Katie, thank you. Some of those names have just had a massive run through 2023, particularly Novo Nordisk. Let's turn to tech. Apple racing to tweak its smartwatch software just days ahead of a potential ban in the United States. Alex Webb joining us out of London for more on this story. Alex, great to catch up, buddy, once again. Just go through the latest for us and what's going to happen over the next couple of days.
So what we've seen is that the US International Trade Commission has imposed a ban on sale of the two most recent, most cutting-edge versions of the Apple Watch starting on December the 25th. And it all relates to the blood oxygen measurement feature that exists on those devices. There's a medical technology company called Massimo based out in California, which has successfully argued the case that Apple's technology infringes upon its patents. That is what has brought this ban into effect. So what Apple is going to do is they're going to stop selling these devices online in the US starting on Thursday and in their retail outlets starting on Christmas Eve. That doesn't mean if you're in the US you won't be able to buy this device if you really want it. You can still get it in Walmart, in Costco and other third-party retailers. But it's a bit of a blow to a device which analysts estimate generate about $17 billion in annual revenue for Apple. Some context to that, of course, Apple in total generates $380 billion in revenue. So while it is a meaningful part of the business, it remains perhaps just less than 5%.
Which explains why the move is pretty small this morning. Alex, thank you. The stock is up by about 1/3 of 1%. Let's turn to pet care. Those stocks moving after Jefferies initiated coverage on the industry, seeing potential for e-commerce sales, favorable customer metrics, and a whole lot more. Simone Foxman on top of this one. Hey, Simone.
Hey, John, many of these pet names have been really beaten down. You look at especially the retailers, the likes of Chewy, down about 80% since hitting a high at the beginning of 2021. Petco down about 90% since around then as well. This as folks got out of their homes, went back to the office, and were less likely to suddenly go out and adopt pets as they did during COVID-19. But Jefferies seeing a lot of positive signs for this market, talking about how average spend per household is up 60% since 2019, mainly driven by people buying higher quality products for their pets. So that's going to benefit names like Chewy, several growth and margin levers at its disposal, according to Jefferies. But it's not necessarily going to help folks like Petco, which is focused on a little bit more the value oriented of that play. But the real winner for Jefferies as they initiate coverage of this space is the animal health sector. So Pet IQ, for example, which distributes both top-end third-party medications, but also has its own in-house tick and flea medications. That's going to benefit. And best in show, Zoetis, the global leader in the $45 billion plus animal health market, they say. Those names moving a little less this morning, however, partly because they're a bit of a consensus view, whereas the retailers, including Chewy, up about 5%.
Best in show, very smart. Simone, thank you for that. Appreciate it. About 6 minutes into the session, here's the broader market for you. On the S&P 500, advancing by about 0.1%. Similar move on the NASDAQ. Outperformance again on the small caps. The Russell up by more than 1 full percentage point. The outlook is really constructive. Michael Hartnett of Bank of America, we mentioned the Global Fund Manager Survey a little bit earlier this morning. Just go through the headlines of that. That Fund Manager Survey, the most upbeat since January 2022. That was the last time we had all-time highs on the S&P 500. People are deploying capital. Cash levels have been cut to 4.5%. B of A says that's a 2-year low. Just 2% of investors, 2%, just 2% of investors expect higher rates. 18% looking for higher yields in 2024. Oppenheimer's John Stolfers feeling optimistic about 2024, writing this. Comments from officials at the Federal Reserve, along with positive economic data and better than expected earnings results, has made a case that enough things might be getting better to offset the degree of uncertainty. I'm pleased to say that John joins us now. I'm pleased to say Mohammed is still with us. John, I want to start with, not next year, I want to start with last year. 12 months ago, you and I having a conversation, and the average price target on the street for the S&P 500 was 4,000 year-end this year. 4,000. We're almost 20% above where people thought we would end this year. John, before we get into 2024, I think we have to talk about what people got so wrong in 2023. You were bullish, you were lonely, you end the year with lots of company, but what did we get wrong?
Well, great to be on the show, John. I've got to say that I think what happened is people didn't trust the Fed. They didn't recognize that the Federal Reserve showed extreme sensitivity in the process of a rate hike cycle, so that as it practices its mandate to establish a good economy and low unemployment, or essentially full unemployment, 3 to 4%, whatever, depending upon the particular period in time you're looking at, they thought that the Fed was going to disregard that and just go for the inflation. And it would appear that Jerome Powell really took a page out of Ben Bernanke's new Federal Reserve approach that started and continues in that legacy. And the sensitivity the Fed has shown gave us a job market that is very well, is running nicely. Consumers, even as they slow their spending, still spending, and businesses being remarkably resilient through, if you look at third quarter earnings and even second quarter earnings.
So, John, next year you're still constructive. The bad stuff didn't happen. The good stuff did. Can you tell me how dependent your new call for next year is on rate cuts from this Federal Reserve? How dependent or independent is it of what happens at the Fed?
As you know, John, our thoughts on this are that the Fed might very well not cut rates until the second half of the year, and might even do it perhaps as late as in the fourth quarter, and might only do one. We think the Fed is very much committed to getting to that 2%, or at least having that as its target. Okay, I don't know where they'll finally end up, if a little bit over that, but I think they're very much committed, because Jerome Powell does not want to be remembered as the predecessor of Paul Volcker was. You know, I mean, that was a very unfortunate chairman, because it required Volcker to take extreme draconian measures. And when you look at it, this is not the case. This is very much a modern Fed, highly communicative and sensitive, but still concerned about inflation. And you just don't want to go back to the late 70s.
So, John, if I heard you right, you think the Fed may not cut till the fourth quarter. You think we may only get one cut. The market thinks we're going to get 6 cuts. The market thinks it's going to start as early as March. If you are right, doesn't that imply that we see some pullback in this rally?
I think so. You know, Mohammed, we had a 4,400 target for this year that we put in last December. It was realized at the end of June. By the end of July, we saw the way the market was running. We even went up as high as 4,900. And then when we saw that pullback that occurred, we moved back to the 4,400. We were looking for about a 7% upside from where we had been at the lows when we were around the 4,100 point, sometime around late July, as I recall. So when I look at it, I would think that we could get a bit of a pullback in here, but I still think the market closes positive for the year. 4,400 or above that looks good to me, but I don't think we're going to 49. I don't know. You know, we may see 48 in the next few days, but we're not finished with the year. And the concerns you and some others express, and myself, it just looks like we've gotten a little bit too exaggerated. It doesn't mean we're not positive on equities. It's just that markets can get ahead of themselves. And if we don't just trim a little bit in here, we may see trim early in the first quarter of next year.
So people listening to you, and they'll be listening to you very carefully after your great call for this year, congratulations, are going to try to figure out, is John telling us to take some chips off the table for now? Or is John telling us just stay invested, fasten your seatbelt, it'll be fine?
It's the latter point. It's stay invested, know what you own, know why you own it, and have right-sized expectations of how it's going to perform. So the emphasis is on quality. Whether you're in large, mid, or small caps, focus on the quality issues, we would say, and remain diversified. So, you know, hopefully they picked up some of the 5%ers in the treasuries when we were at those levels. That would help diversify a portfolio, and you still have good yields available in tax-frees and in corporates. So,
John, I'm guessing when you say remain diversified, you don't mean own the market weight S&P 500. What would you be doing? Stock specifically?
We like to be selective. Our emphasis remains on technology, on industrials, consumer discretionary, and we can't help but like financials in here. We think the financials are beginning to heal from that scare that they had in March, which impacted the large cap financials. We're a little bit, we're still cautious related to the regionals, but we think they've avoided a systemic problem. It looks like that was all idiosyncratic. So we do, we like financials as well. We think those are good places to be right now in terms of where we expect outperformance moving into next year, and we think they can weather any kind of storm we experience.
We've seen the outperformance there over the last couple of months, that's for sure. John, we've got to leave it there. Great to catch up, buddy. Enjoy the Christmas holidays. John Salford's there on the latest. The banks have rallied so hard, 25% higher over the last couple of months. Mohammed, just a quick word on that. Do you think we've left behind the problems of spring? Have we left that behind?
I don't think the problem of spring was systemic. There were a problem with a few banks. Have we left behind the possibility of a few banks still mismanaging their balance sheet? No. But the banking system was sound. The banking system is sound as a whole.
Big rally over the last few months for the financials on the S&P. Mohammed's going to stick with us. Coming up on this program, Houthi attacks threatening global trade in the Red Sea.
Every week that transit through the area is difficult, will have a big impact on trade flows and big impact on freight rates because, as you know, we will have to sail around the Cape of Good Hope.
Team coverage up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
every week that transit through the area is difficult, will have a big impact on trade flows and big impact on freight rates because, as you know, we will have to sail around the Cape of Good Hope. The first consequence you would see, and we're seeing it already today, is that freight rates will start to go up. Obviously, the second consequence you will see in a couple of weeks from now is that the supply chains will be distorted heavily, a little bit like we saw with Ever Given and during the COVID crisis.
The Euronav CEO weighing in on volatility in the Red Sea, escalating Houthi attacks threatening to shut down the area's delicate shipping ecosystem, cutting off crucial cargo access to the Suez Canal and sending all futures soaring just yesterday. The US announcing a new task force to address the issue.
America's commitment to Israel is unwavering, and no individual, group, or state should test our resolve. So in the Red Sea, we're leading a multinational maritime task force to uphold the bedrock principle of freedom of navigation. Iran's support for Houthi attacks on commercial vessels must stop.
Team coverage starts right now with AMH in Washington, D.C. and the brilliant Javier Blas over in London. Javier, let's start with you. Just how delicate, Javier, is the situation currently?
It's very delicate and particularly affecting the container shipping industry. About 50% of the world's container shipping capacity has stopped using the Red Sea. That means also the Suez Canal. And of all the traffic that is bound to the Suez Canal, about 70% of it has stopped using it. Importantly, the announcement overnight from the U.S. administration that a new task force will be formed has been responded by shipping companies with effectively, this is not enough, we need more protection. We need the threat to be stopped. And for now, those companies that they have announced a pause in using the Red Sea, now they are announcing that they will start sailing around Africa in a way permanently until the situation improves.
Anne-Marie, let's talk about the official response. Javier touched on it. What else can officials do?
Well, at the moment, we do have today Lloyd Austin convening a ministerial meeting regarding this as they announce this new task force. But Javier is getting to the point of the fact that many people are shrugging this off because a maritime task force already exists, Jonathan, that focuses on the Red Sea. Now, this new task force will be operating under it. So it begs to question why they just wouldn't use the original one or what the original one is missing. When you look at the members that are joining this new task force, it's the like of Italy, Netherlands, Bahrain. Notably missing is Saudi Arabia and the United Arab Emirates. But we should note the U.S. has a tremendous amount of firepower in the region right now. Dwight D. Eisenhower Aircraft Carrier Group, the USS Carney. The question and the debate right now happening in Washington, and I'm sure as well with Abu Dhabi and Riyadh listening as well, is whether or not the United States will go and have a military attack, Jonathan, on these Houthi militants.
And Marie, how important is it that you have local players join this coalition?
Well, it's incredibly important, which is why a lot of people are wondering why individuals like Saudi Arabia, like the United Arab Emirates, like Egypt, which can lose a tremendous amount of money if the Suez Canal, you do not have the freight going through the Suez Canal and these ships and carriers going through the U.S. Canal, and India as well. Why are they not part of it? That begs a big question because they have a lot to lose if this was shut down.
Javier, do you have an answer to that?
Well, very difficult to convince the Saudis that have been fighting in Yemen for many years and not really getting anywhere, or the UAE, which has also been fighting there and getting absolutely nowhere, and being criticized by the West for human rights violations in Yemen. I think that effectively Riyadh and Abu Dhabi are saying, we tried to resolve this problem, we didn't have much support from the West, now the problem is you, so it's up to Washington and the Europeans to resolve the problem. But here is an interesting view, perhaps from London. We are asking what America can do, what the U.S. Navy can do. But if you think about which blocks are most affected by what is happening right now in the Red Sea, that's not the United States. It is China, which is exporting to Europe via the Red Sea. So after all, this is a problem for the European Union / the United Kingdom and China / India. And neither side is really making much contribution to what the United States is trying to do on the ground, or better, on the seas in the Red Sea.
Such a good final point. Javier, thank you, sir, for being with us. The brilliant Javier Blas alongside the excellent Anne-Marie Hordern down in Washington, D.C. We're going to wrap things up with Mohammed next on the programme, get some final thoughts on 2023 and look ahead to 2024. In your equity market right now on the S&P, positive by 0.3%. Final thoughts with Mohammed and your trading diary up next.
do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Stocks higher, 25 minutes into the session. Let's get to the trading diary. The day ahead looks like this. Atlanta Fed President Raphael Bostic speaking at 12:30 Eastern, plus FedEx reports after the closing bell. Thursday, US GDP and another round of jobless claims, followed by quarterly results from Nike and Carnival Cruise Lines. Friday, the US bond market closing early for the holidays. Before we run away for the holidays, just a final word with Mohammed Al-Arian. Mohammed, looking back on 23, looking ahead to 2024, one big last thing for you. What's the big risk for next year from your perspective?
I think it's both a risk and an opportunity, which is volatility that causes more dispersion. John, we've banked early the major supportive top-down factor, and that is that the Fed would pivot to loosening and considerable loosening. Well, we've banked that. That is what's pushing us and will continue to push us for a while. The what next, it's not going to be a top-down factor. It's going to be bottom-up. So more volatility and more dispersion.
Mohammed, thank you for today and for the whole of 2023. Thank you, sir. Appreciate it as always. Enjoy the holidays from New York City. That does it for me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. Coming up, we're going to see where this Fed is going. Are they really as dovish as maybe Fed Chairman Powell hinted at? Ira Jersey, Chief U.S. Interest Rate Strategist, he'll join us. Chester Dawson, editor, team leader of North American Transportation with Bloomberg News, is going to join us to talk about this Blue Origin launch and what it means for space tourism. Sign me up for that. Robert Teeter is going to join us in studio, one of those smart people that we talked to, managing director and head of investment policy at Silvercrest Asset Management. So that's all coming up in this hour. We got a lot of stuff happening, so stick with us. And we're going to kick things off with Charlie Pellet. How about that?
How about that? Here's what's going on. Stocks continue to push higher. Yes, another day of records on Wall Street. Best level of the day right now, right to the numbers. We've got the S&P up 11 points right now, up by about 0.2%. Dow Jones Industrial Average higher now by 129 points, up by about 0.4%. And the Nasdaq Composite Index up 37 now, up 0.3%. The Nasdaq 100 Index keeps on going. Record there up 19, up 0.1%. Broad-based Tuesday rally with the Russell 2000 up 32 points, leading the way higher. The outperformer right now up by 1.6% on small cap shares. So the Dow, the S&P, Nasdaq are all higher. 10-year yield 3.89% with the 2-year at 4.42%. Spot gold right now up $14 the ounce to 2,041, up 0.7%. West Texas Intermediate crude now back with a 73 handle, 73.30 a barrel on WTI, up by 1.1%. Bank of America CEO Brian Moynihan says the bank is continuing to invest in its markets division as it seeks to increase market share. And in a wide-ranging interview on Bloomberg Radio this morning, Moynihan also talked about the U.S. economic backdrop and the health of the American consumer.
What we look at is what goes on in our core customer base, and we try to talk about what is going on as opposed to what could go on and plan for what could go on. And, that's been relatively strong. And our team, the spending continues even today at about 4 to 5% over last year, half the growth rate of 22 to 21, showing the consumer has slowed down, consistent with inflation getting under control, consistent with, the Fed using the rate structure to choke off some of the activity, and it's happened. But overall, it's been a decent year.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. One economic note, new home construction unexpectedly surged in November to a 6-month high, benefiting from a dearth of existing houses on the market and suggesting the crunch in residential real estate is easing. Today, Toll Brothers among home builders up 1.3%, Lennar up 1.4%, KB Home up by 2.6%. Recapping stocks push higher, S&P up 10, a gain now of 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Jess Metton, sitting in for Matt again. Or you're sitting in for whoever. I mean, you're kind of our de facto Like,
oh, am I? What an honor!
So.
I would love to be y'all's de facto.
Absolutely. We'll see what happens
but
here.
Hey, the S&P 500 less than 1% away from an all-time high.
Yep, absolutely. The Dow is there at an all-time high, so it's good stuff there. Jess Metton and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can go to youtube.com. That's the internet, and you can go to, search Bloomberg Radio, and that's where you'll find us. As Charlie was just reporting, we've got a little bit of green on the screen here. The S&P up about 1/4%. Let's look under the hood and see where some nuggets are here in this early trading. We do that with Bloomberg Equities reporter Bailey Lipschultz. Bailey, what do you got for us?
Yeah, just want to call out, guys, that the equal weighted index, the SPW, up 0.6%, so more than twice what we're seeing for the S&P 500. More than 400 names in the green. So breadth happening. We're getting away from
broadening the breadth.
While you're speaking, I'm going to pull up the RSI function on the SPX and just see if I'm buying them or am I selling them today here. So the RSI function, relative strength, we are above the limit. We're at 81. Usually it's 70.
Correct. But when I'm speaking with my sources, a lot of them don't just look at daily charts. They look at weekly, monthly as well. So even though a lot of people have been talking about, hey, RSI is above 70, some technicians are arguing there's still room to keep going here.
I'm calling up my desk right now.
Mark Newton over at Fundstrat was talking about this. Still feels like this has legs.
All right.
Well, talking about stocks that have legs, looking at J&J's spinoff Kenvue, stock rallying.
That was a good IPO, 6%.
Right? Well, it was a well-priced carve-out, ticker KVUE. So with a carve-out, you basically have a spinoff, but then you raise some cash in an IPO. Okay. Started out hot, not trading as well as it had been, falling under a bit of pressure. But this ruling about ruling against class action, alleging Tylenol causes autism, is a win for the company. So this is a U.S. District Judge concluding Monday that plaintiffs in the more than 400 suits accusing Kenvue and other makers and sellers of acetaminophen relied on flawed science in seeking to prove an increased risk of developmental issues in babies. So, overhang. No one wants legal overhang.
Tylenol, for me, is the miracle drug. I take 2 of those things. I don't care what's going on. I mean, at some point in my life, the doctor's going to say, Mr. Sweeney, I'm sorry, this is it. I'm going to be like, don't worry, just give me a couple of Tylenol.
I'm an ibuprofen guy, though.
Are you? Okay.
See, that's my go-to. I think it's technically better for your liver with drinking.
You know what? Whatever's in my medicine cabinet, I grab. So whatever works here.
It's just amazing. Tylenol. It's just the miracle drug for me. And I'm old enough to remember when they had that tampering issue.
Oh, I remember that. They didn't have in the bottles the little
the seals.
And now that's a Harvard Business School case of how crisis management, how to react.
That's a perfect example.
And they did a great job back then. And that's kind of when you have something like one of your key products, something goes really wrong. Yeah. In this case, I think there was some poisoning or some tampering with the product. And they turned that around quickly. So it's interesting to see Tylenol back in the news.
Yeah.
Anyway,
So
big fan.
Big fan. Big fan. So I just got to ask. So you're a branded Tylenol buyer. You don't just buy your
like a knockoff.
Set of medicine.
There's a handful of things I have to stick with the brand for no reason, and that's one of them.
Another stock that is a brand people are getting more comfortable with, a firm holding buy now, pay later play, ticker AFRM, right now up 13%. This coming after it expanded at self-checkout in Walmart stores, so 4,500 Walmart stores. Now if you use self-checkout and you want to use buy now, pay later.
Self-checkout. Initially, I didn't like self-checkout. Now I gravitate towards it. I don't care how much stuff.
What was a put off for you in the beginning?
Change. I'm just like, I got to do more work here. Can't I just have somebody do this for me? Now I'm like, why would I?
And then you got tired of waiting in line.
Yes, and I just kind of go.
Yeah.
The only thing I don't like, the only thing I struggle with sometimes is the produce at grocery stores. If it doesn't scan, then you got to punch in the code.
But they make it pretty easy for you now. You type in B, bananas comes up, and you hit the little picture.
Look at Sweeney.
That's what I'm talking
all over.
Well, if we're talking Sweeney shopping trends, what's your go-to grocery store?
Ooh.
I don't know where we go. ShopRite.
ShopRite. I'm a ShopRite guy.
Yeah. I feel like Jersey ShopRite.
Yep.
Works out.
Yeah.
One stock that had been higher, now only up 0.2% is Apple, ticker AAPL. Bloomberg reporting that the company is racing to tweak the software ahead of that U.S. watch ban. I know you guys spoke with Dan Ives yesterday. Had been something we were keeping an eye on. So maybe they're going to be able to address some of the issues underlying that. It did end the day down 0.9%. So still keeping an eye on Apple. But again, as we see see this breadth as we see investors buying up other stocks. Even if you look at a company like NVIDIA, which is down 1.5% right now, we are seeing investors putting some money to other areas. In one area that really is benefiting, beaten down solar energy stocks. We're looking at Enphase Energy, ticker ENPH, up 8% right now. First Solar also was catching a bid, ticker FSLR, up 6.6%. Enphase, though, cutting 10% of staff, closing factories amid the solar slump. So these are very capital-intensive companies, out of vogue when interest rates are really high and we see investors shying away from risk. But looking at the group, broadly speaking, maybe a bit more nibbling, but when you look at the broader performance for some of these companies, not anywhere near where it was in 20 and 21.
Nice.
All right, Bailey Lipschultz, fantastic report as always. He's in the studio today. He's not mailing it in. We appreciate
He never
that.
does. He's always here.
Always here. Where's he going to go? Bailey Lipschultz, he's equity reporter for Bloomberg News. We appreciate it. I don't know. All right, we had Fed Chairman Jay Powell.
Yes.
His commentary, the markets read it as overtly dovish. Now it feels like some other members of the Fed are trying to walk it back a little bit, kind of put the genie back in the bottle a little bit. I'm not sure if that's their intent, but that's kind of how it feels like. So let's check in with somebody who actually gets paid to think about this stuff. Ira Jersey, Chief Interest Rate Strategist for Bloomberg Intelligence, working from the comforts of the home office.
Wow, look at that background.
God
And for our
forbid he comes
YouTube
into
viewers.
the office. Yeah, so we want to keep Ira happy. He's a player. We got to keep him happy. If he wants to work from home, he can work from home. That's how we play it
I
there.
feel like that's the first time I've heard you say that for one of your Bloomberg Intelligence.
Exactly, putting my BI hat on again. Ira, thanks so much for joining us here. Again, am I reading that right, Ira? Does it feel like some of the Fed officials are trying to just walk it back a little bit? Maybe the markets have gotten ahead of it themselves?
Yeah, so there's a few members certainly who have sounded a little bit more hawkish than Jay Powell did during the question and answer period of the press conference last week. You know what was interesting is we applied our natural language processing model to see how hawkish or dovish the computer, the AI, basically spit out. Where was Jay Powell during his opening remarks? And he was amazingly balanced. So he was just as hawkish and dovish as he was the meeting before, but during the question and answer period, almost all of his answers were very dovish, and that I think is something that some members are trying to at least talk back a little bit. The market's not yet believing them. That the market hasn't sold off significantly. Looking at meaning the Treasury market, you still see yields a lot lower than they were prior to last week's meeting.
So are officials actually walking back what Fed Chair Jerome Powell said, or is this a situation where they're trying to make it more clear when they're talking about cuts, and when you're looking at the dot plots pricing in 3, it sounds like they're trying to make it clear this is something that would potentially happen in the second half of next year, not necessarily as soon as the spring or even as early as March?
Yeah, I think that it's exactly the clarification. And keep in mind, I think this is partly the market's hearing what it wants to hear, because in just about every single statement that you've heard from Fed officials, it's if then. So if inflation continues to come down very aggressively, then we will respond with interest rate cuts. But then again, what they're not thinking is, okay, if inflation doesn't come down, then we're not going to do anything. We're going to just stay on hold, right? So I think it's that second if-then statement that the market's missing and subscribing a much lower probability to than what will actually be realized. In fact, our view is that that inflation, while it's going to continue to come down, it'll come down much more slowly on a going forward basis. So the Fed, while it might cut in 2024, it's going to cut later than the market's pricing, and then also not as aggressively as the market's pricing, which is different than some people on the street, right? So I know a couple of big banks have come out and said that they thought that the Fed might cut 200 basis points next year. My view is that they probably don't go quite that aggressively.
Ira, are you surprised, or should we be surprised at how much the 10-year has moved here from 5% to now to 3.89%? And as Tom Keene would like to say, in about the time it takes to drink a cup of coffee here?
Yeah, pretty much. I mean, certainly the pace of the rally and the volatility that we had last week, I think, is partially a sign of the market readjusting, and certainly a lot of people were long, and wanted to, and those people who weren't long had a fear of missing out, and they just just kept going and got unwound shorts or got long the market just so they could participate at least least a little bit in the rally. That being said, I think it's. I'm going to pat myself in the back a little bit here, but in September we adjusted our 10-year yield forecast to be 3.76% for the end of this year, and we got laughed at, right? Because everyone's like, "Oh, we're at 4.75%." I mean, we called it. We're set up for the mother of all rallies. Now we were a little bit early, I admit that, right? We went from about 480 when we put that call on up to 5% on 10-year yields, but look at where we are now. We're a stone's throw away from our year-end forecast, and I'm not going to forecast out, hey, are we going to get the 476? But right now, I think that if you were long back at 5% or 4.75%, then it just makes sense to say, hey, we now had a pretty decent year in fixed income. We were at a negative total returns in the Treasury index just a couple of months ago, and now all of a sudden we're up 4.5%, 5%. So that's a reasonable return for a fixed income investment. Let's take some money off the table and readjust at the beginning of next year.
How much more room do you think the 10-year has to fall next year?
Yeah, so our forecast is 3.22% for 10-year yield at the end of next year.
Not 3.2, but 3.22.
3.22, yeah.
That's what your model kicks at. Okay, Ira has a model, and his team, they have a model.
I love that.
It's kind of a weighted average of several different models. Actually, we have a number of them. Yeah, but interesting. But importantly, and I think that this is the thing that we, yes, you want to probably be long duration for next year, particularly if our forecasts pan out. But 2-year yields, I think, will come down even more aggressively, right? So we're looking at 2-year yields coming down to about 3.25%. So basically, the yield curve being very inverted right, as I look at the Bloomberg terminal by 54 basis points between the 2-year and the 10-year. I expect that basically to be zero by the end of next year, and that's probably going to be a big adjustment to the curve over the course of 2024.
So you're at a cocktail party. Somebody comes up to you, Ira, and says, has the Federal Reserve done a good job here over the last several years? What do you say?
Yeah, I think I would give them like a B maybe overall. They certainly were. I think there were a couple. Yeah, well, some people would say that I'm a hard grader, and other people were like, well, they've definitely failed, right?
Well, could you argue that it ended up being transitory, even though Powell tried to ditch that 2 years ago? When we look 2 years out, how do you feel about that? To Paul's point.
Well, I think there's a couple of things. If we go back to 2021, and Paul asked about the cycle, right? Did they get the cycle right? I think firstly, the Federal Reserve didn't start to reduce the pace of balance sheet expansion early enough, right? They continued quantitative easing even when the economy was already growing at very substantial levels in both real and nominal terms. And then on the back of that, they also didn't start to increase interest rates, quite quickly enough, and kept interest rates at zero and kept monetary policy very easy, even when it was pretty clear that we were going to have a pickup in inflation. I mean, it wasn't obvious that we were going to get 9% inflation, but it was pretty clear that we were going to have 3, 4, 5% inflation. And you don't keep interest rates at zero when you have incredibly low unemployment. So I think the pace that they started was late, which is the reason why early on I would give them a worse grade. But once they got through their heads that, hey, we have an inflation problem, we really have to step on the brakes here, they really started to go, and they surprised me, quite frankly, by going 75 basis points a clip for 4 meetings. I mean, I had expected them to be 50 basis points for longer. So anyway, I think that they ultimately did an okay job, but they kind of missed the boat early on.
All right, Ira, great stuff. As always, he is our go-to voice for a lot of institutional investors around the world for U.S. interest rate strategy. That's Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. He can work anywhere he wants because he's that good. And he's got a much better record in that regard than BI management, so I'm just going to leave it there. That's another matter. Yeah, that's another matter for another time. So, yeah, exactly. S&P 500 up 0.3%, NASDAQ up 0.4%. The Russell, hey, the small cappers, another big day, up 1.5%. That's something we've seen over the last several weeks. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. Apple is racing to stop a ban in the U.S. on some of its smartwatches, set to start on Christmas Day as a result of a patent loss. Bloomberg's Alex Webb has more on what will happen over the next couple of days.
And what Apple is going to do is they're going to stop selling these devices online in the US starting on Thursday and in their retail outlets starting on Christmas Eve. That doesn't mean if you're in the US you won't be able to buy this device if you really want it. You can still get it in Walmart, in Costco and other third-party retailers. But it's a bit of a blow to a device which analysts estimate generate about $17 billion in annual revenue for Apple.
Now, engineers at the company, they're trying to make changes to algorithms on the device that measures a user's blood oxygen level, the feature that Massimo argues infringes on his patent. Apple right now up about 0.2%. Alphabet will have to pay millions to resolve antitrust complaints. Bloomberg's Gina Cervetti has that story.
Google's parent will pay $700 million and alter its policies to settle claims that its Google Play App Store unlawfully dominates the Android mobile app market. The deal resolves antitrust complaints brought by attorneys general in about 36 states, along with consumers.
Alphabet is up about 0.6%. And buyout firm Carlyle Group and technology investor Insight Partners have reportedly topped Blackstone in a competitive auction process to buy risk management software and services provider Exeger. Now, sources tell the Wall Street Journal it's at a valuation of about $1.2 billion. That deal still subject to closing conditions and regulatory approval. Carlyle Group is up nearly 1%. Those are the company stories we're following this hour. More Bloomberg Markets coming up. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, and NASDAQ all advancing. Yes, we are looking at records. NASDAQ 100 index continues to move higher, up 0.3%, up 47 points right now. The NASDAQ Composite Index up 0.4%, higher by 58. The S&P 500 index up 17, up 0.4%. And as we mentioned, the NASDAQ 100 index had a record there, up 0.3%. Russell 2000, though, the outperformer today, the index of small cap shares up 1.5% right now, higher by 28 points. We have got the 10-year yielding 3.89%, with a 2-year 4.43%. Spot gold up 0.8%, 2,040 for the ounce on spot gold. And West Texas Intermediate crude also advancing today. WTI just above 72, actually right at 72.98. Was trading above $73 a barrel a few minutes ago, higher now by 0.7%. There is surprising strength in today's housing data. And with that story, here's Bloomberg's Vinny Del Giudice.
November housing starts at a 6-month high. Builders are benefiting from the dearth of property listings. Loan costs are down, too. The average mortgage rate dipped below 7% for the first time since August. there are signs the Federal Reserve may be done lifting interest rates that stop inflation. Vinny Del Giudice, Bloomberg Radio.
Among the names reporting today after the close of trading, FedEx. Ahead of that report, FedEx shares are lower, down by about 0.3%. Rival UPS also lower by 0.1%. Again, recapping, we do have stocks higher with the S&P up 16, gain there of 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate it. Jess Metton and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Let's talk space here. Blue Origin space tourism rocket is slated to fly to space Tuesday for the first time in 15 months, potentially marking the resumption of regular flights for the Jeff Bezos-founded company following an in-flight failure last year. To bring us up to speed on that, we check in with Chester Dawson, editor, team lead of North American Transportation with Bloomberg News. He's based out in Detroit. Chester, good news, I guess, here for Jeff Bezos and Blue Origin. What's the status here? What's the story?
Yeah, well, they expect to lift off, as you say. Initially, this was supposed to go up yesterday, but shortly before launch, they called it off, citing a ground system error that they've apparently cleared up. And yeah, as you say, it's a pretty big moment for this space program, for Blue Origin, and for Jeff Bezos personally.
And you mentioned that the launch had got scrapped and some other potential reasons as to why that happened, but what have been some other reasons as to why we've seen maybe other ones scrapped recently?
Well, for Blue Origin in particular, they were basically, doing a big investigation and getting FAA approval following a mishap, 15 months ago. And they've had some issues with the development of their new engine and an even larger, newer rocket. So, I mean, as our dedicated space reporter, Lauren Grush, likes to say, space is hard. And that's why it takes rocket scientists to do it. But what was a little worrisome about this last mishap, which caused them to put their program on hold for a while, is that while there were no people aboard, this rocket and spacecraft is designed to carry passengers. So the one going up today will not be carrying anyone, and the one that had the mishap 15 months ago was not carrying anyone either. But they could, and that's why it's super important that they make sure this goes off without a hitch to reassure potential passengers that the rocket is safe.
Hey, Chester, when Jeff Bezos left his role as CEO at Amazon, he said part of the decision so he could spend more time focusing on Blue Origin. Have we seen any changes to the way they operate or anything like that, changes in strategy?
Well, they do have a new CEO, which is a pretty big development. And, Bezos, as you say, has pledged to devote more of his time to it. He says he wants to enable the company to move quicker, to be more decisive. Now, obviously with what I just said about safety being the biggest priority, there's only so far you can go. But I do think in comparison to, say, Elon Musk and SpaceX, that Blue Origin has been, more the tortoise than the hare in this race. And they are competitors, and Bezos does want Blue Origin to win a larger share of that burgeoning commercial and government space cargo market. So, I can't say any specific example of other than getting a new CEO, but the tone has changed, and we'll see if the pace of rocket launches and development increases.
What do we know about other launches that could be coming up in the next few months?
Well, the big thing for this company, Blue Origin, is getting back on track with this rocket, which is the one that carry space tourists and research equipment and all sorts of other things. But really what they want to do is start to get on track for development of their new larger
rocket. So this is called the New Shepard. The newer one is called the New Glenn. And that's the one with the state-of-the-art engine, which they also hope to sell to United Launch Alliance, which is a competitor of sorts. It's also a big rocket launch provider, but they use or want to use Blue Origin's engines. So ULA itself is going to have a launch early next year. I think it's scheduled for January 8th. That's a pretty big deal because ULA is, one of the preeminent rocket launch companies and is a joint venture of Boeing and Lockheed Martin. There's a lot of rumors that its future is might be up for grabs if they decide to sell or explore any number of options. The CEO recently told us that the company is entering its new phase of growth, and they're definitely looking toward growing out of their current joint venture structure. So a lot of things happening on the space beat, a lot of launches coming. And of course, SpaceX, which is, the biggest and baddest, I guess, also has a pretty aggressive schedule for 2024.
It just seems to me, Chester, and I think for some others as well, that the space business, like I grew up with NASA, waking up early in the morning to watch the Apollo lunar landings as a kid. Now it seems like in a privatized space business, it's just the world of billionaire guys, Bezos, Musk, that kind of thing. Is that kind of how the industry is evolving? And is that a good thing, or?
Well, I mean, that's a really excellent question, and it gets to the heart of the space program, in the 21st century. While there is a big government component and NASA works hand in hand with these companies, you're right. It's no longer the space shuttle, and NASA kind of directing every move. They basically opened to the private sector in large part for cost reasons. And because the private sector, as we've seen with Musk and SpaceX, can move pretty quickly to get things done. The advent of reusable rockets, who would have thought? So, whether things were better, in the good old days or not. I mean, obviously, when you talk about man landing on the moon and the tremendous accomplishments that NASA had, right up through the space shuttle, it's hard to knock that. And as a national champion and a national program, certainly, that was something that, school kids and scientists throughout the country could look toward. But, this is probably a slightly more realistic vision for how space is going to develop. I mean, really in any sector of the economy, name me a state actor which is developing technology. Exactly. So I don't know if it's good or bad, but it's where we are.
At what point will we see more wealthy tourists on some of these launches again?
I think pretty soon. I mean, Virgin Galactic, which is also in this arena and does these suborbital, flights, is continuing, and I mean, they've got some financing issues, so that's a whole separate question. But, assuming that this launch goes up flawlessly, I wouldn't be surprised if they restart that aspect of the program, they being Blue Origin, in pretty short order. So, that remains kind of a, it's kind of the celebrity side of these launches, and it will get, more routine. But again, you're talking about a pretty tiny slice of, their business, and also the number of people that are going to do this are a fraction of I mean, it's probably the same number of people who would like going on in a submarine or something, right? I mean, it's not a business model that I think you could quickly and easily open to the mass market. So it'll always be something of a niche product. But it helps these companies fund their development programs. It keeps them in the public eye. And it's also kind of cool, right? I mean, if you were to win the lottery, then, maybe you will be up on one of these in the not too distant future. Of course, the promise is that eventually, once the technology improves and they get to the point where they can, like Musk wants to send rockets up, I think he said every week or something, or several times a day. I mean, we might get to that future, but it's not going to be anytime soon. So yes, those space tourist flights will continue, and it will be a money earner for these companies. But it's not going to be like going to Disneyland with your kids, at least not in our lifetime.
All right, Chester, thank you so much. We appreciate that reporting. Chester Dawson, editor for the North American transport team lead there for Bloomberg News. Stay on top of Mr. Jeff Bezos. Blue Origin set to fly today. Resumption of flights here, so we'll keep an eye on that. S&P 500, that's up 0.4%. The Nasdaq's up 0.5%, and the Russell 2000 up 1.5%. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Amy Morris.
All right, thank you, Paul. And just as an aside, the launch window for Blue Origin today opens about 1 hour from now, so we are watching that for you. More commercial ships have come under attack by drones and ballistic missiles fired by Houthi militants while passing through the Red Sea. As a result, a number of shipping companies are diverting their fleets around Africa. Defense Secretary Lloyd Austin announced a new maritime task force intended to protect commercial vessels traveling through the Red Sea.
These reckless Houthi attacks are a serious international problem, and they demand a firm international response.
The U.S.-led 10-nation security initiative is called Operation Prosperity Guardian. Shipping in the Red Sea is now grinding to a halt. Senate Republicans, have closed the door on a quick deal on border security, leaving votes on Ukraine and Israel aid waiting until the new year. Senate Majority Leader Chuck Schumer had said that a vote would likely come this week, but John Thune, the number 2 Senate Republican, said negotiators are not able to resolve any sticking points, and while it's possible the parties might be able to reach a deal in principle by the end of this week, that only tees up votes on the legislation for the first or maybe second week of January. President Biden's re-election campaign plans to put more of a focus on abortion rights to try to turn his fortunes around. We get those details from Bloomberg's Jody Schneider in Washington.
Vice President Harris is going to go on what they're calling a abortion rights tour on the anniversary of Roe versus Wade, January 22nd. They're going to make this an issue, and frankly, it's a campaign issue, trying to get women voters and independent voters.
Bloomberg's Jody Schneider in Washington. The latest Bloomberg News Morning Consult poll shows the President Biden, losing support among young voters in 7 key swing states. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. The bull keeps running. The rally goes on. The Dow, the S&P, NASDAQ very much in the green on this Tuesday, right to the numbers, with the S&P up 17 points to 47.57. Gain there of 0.4%. Dow Industrials up 183 points, up 0.5%. NASDAQ, the composite index, up 53 points, up 0.4%. NASDAQ 100 index at a record, up another 32 points, now up by 0.2%. We're looking at a broad-based rally today. Small cap shares very much in the game, with the Russell 2000 up now by 1.6%. We've got the 10-year yielding 3.91%, that 2-year 4.44%. Gold up $15 the ounce to $2,042, up 0.7%. And West Texas Intermediate crude is advancing now by 1%, $73.19 a barrel. Only days to go before we wrap up the trading year. So what changes might investors need to make ahead of potential rate cuts next year? Chris Heisey is Chief Investment Officer at the U.S. Trust Bank of America Private Wealth, and he was a guest this morning on Surveillance.
But ultimately, heading into next year, the common question is always, how should we be positioned? Now, it's about how much and when should I be adding to areas of equities and longer duration fixed income. We talked about it in the summer. We talked about it again in the fall. No one throws up a flare gun. No one rings a bell when that's going to happen. There's always a surprise that comes in. That surprise came with the Fed pivot, particularly Powell. We expect a couple more surprises to the upside early next year.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Apple only days away from a U.S. ban of its smartwatches, and it is plotting a rescue mission for the $17 billion business that includes software fixes and other potential workarounds. Apple shares are higher now by about 0.3%. Again, recapping, stocks are advancing. S&P up another 18 points right now, higher by 0.4%. Very close to the best level of the day. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, you are a broken record, my friend. Markets up for 7 weeks in a row. That's what Charlie's been reporting here.
Yeah.
Another good day in the market. Charlie Pellet, we appreciate that. Jess Metton and Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com. Again, it feels like this market is just really, has it gotten too far over its skis? That's what it feels like to me, at least in the short term. But what do I know? I've only been doing this since 1986. I still don't get it. Robert Teetert, he knows what's going on. He's the head of investment policy in the strategy group at Silvercrest Asset Management. Robert, does it feel like we're a little ahead of ourselves here based upon what we heard from Fed Chairman Jay Powell last week?
It does. We've gotten a lot of progress in the last 6 weeks as we've seen the yield on the 10-year come down from 5 to 4. We've added a lot on the valuation side. Seems like we're fairly valued here rather than undervalued. Need a lot of progress next year on inflation and Fed talk to keep holding those gains in valuation. So I think we're sort of at the end of this phase of the Fed rate cut cycle, or Fed rate cycle, excuse me, flipping from hikes to cuts. And there I am getting ahead of myself too.
Right. So how are you advising your clients to position heading into next year? Because you were mentioning to me earlier that you felt like what has transpired over the past 7 weeks, you were thinking was going to actually take about 6 months to happen.
Yes, I do think it makes next year a bit more challenging. We've compressed a lot of gains into a short period of time. The earnings picture still looks reasonably encouraging for next year. So while the street's at plus 11 or so, my forecast is for around 6% on the earnings side. Okay. I'm not really looking for any valuation progress next year. We've had that in the last 6 weeks, and that probably isn't going to happen next year now. But that still sets the stage for a pretty decent year of mid-single digit returns driven mainly by valuation. And maybe when we get to the end of the year, we're starting to be into the Fed cycle and can get a little more clarity on the outlook beyond that.
Now, Jess, she won't admit to it, but she's owned the Magnificent Seven. She's been long those stocks, so she's just going right to the bank. Me, on the other hand, I have not. What do I do here? Do I chase them into 2024? Do I try to find some of the sectors that have not performed? How do you think about where to go in 24?
The likely scenario in my mind is that the sevens still continue to keep pace, driven mainly by the earnings side. They've got strong earnings potential. That should continue. But small caps will catch up. They've been out of favor for a long time. There's a lot of valuation pressure. That's closed the gap a bit in the last 6 weeks, but I think still more room to go. there are a lot of segments within small cap too that have been pressured a lot by the rate cycle. So as you have an easing rate environment, some of the financing concerns are taken off of the table there. That's probably beneficial for margins, and the small cap side would tend to carry a bit more debt. So I'm not really afraid of the 7 here. They'll continue to carry their own on earnings, but the rest of the market will catch up a bit more.
How do you view financials?
Yes, that's an interesting and challenging sector, but I think the same as the small cap space.
It's also very broad because you have the bigger banks, you have insurers, and then you also had fintech in it that was not originally in that sector, but got moved over because of the GICS changes in the spring in the S&P 500.
I think a lot of that nuance will be super interesting next year. We've had this easy knee-jerk reaction of lower rates, good for everybody, especially good for financials. And in my mind, the story of 2024 is going to be a stock-picking story, a nuanced story of not just sectors, but industry groups, and not even just industry groups, but individual companies and how they're navigating the challenges of a slower growth environment, which frankly is in front of us, so they have to be paying attention to margins.
How about energy here? We've seen a lot of volatility in the price of crude oil across the globe, supply, demand, all the geopolitical issues here. Is that a space that you like into 2024, or is that kind of had its run? Because it's been a sector that everybody forgot about for a decade, it seemed like, and then it's just been really performing well over the last couple of years.
It has been. It's hard to see an environment where those prices continue a lot higher absent more geopolitical risk. Again, just on the basis of a slowing economy. So globally, Asia had been a real powerhouse of growth. That slowed down. U.S., they'd had a massive rebound, of course, in terms of growth. But next year, with a backdrop of probably 2% economic growth, hard to see a lot of upside pressure on commodities next year.
How are your clients feeling right now?
I think they, like most of the rest of the world, are feeling a bit surprised at how quickly the last 6 weeks unfolded. It was sort of very easy back in October to look at the year and say, it's been an okay year, but there are a lot of things that have been lagging. And a lot's happened in 6 weeks.
Did any of them have FOMO from the past 6-7 weeks?
I don't think so. We've done a pretty good job, I think, of keeping clients invested, and our view for most of this year had been relatively optimistic. So we hadn't been in the bearish camp. We had been in the optimistic camp on the year on the basis of the progress that's been made in inflation and economy, mainly on the economy. A lot of folks had a really strong recessionary bias, and we have not had that. And so I think for the most part, we've kept a pretty steady course through the year and not feeling like we're missing out on anything.
How do you view the trajectory of the economy next year?
Definitely slowing. I'm not in the recession camp, mainly on the basis that I think we'll see it coming, and that sounds like very dangerous words, but with the availability of real-time data that we have and the fact that we're still adding jobs in the economy, that means economic growth. And we can debate a lot whether that's 0.5% or 2%, but it is still growth. And I think until we start seeing some signals that economic activity is turning negative, we're in a slow growth.
What are some of your favorite signals that you like to gauge? Because I feel like there's sort of the telltale signs that Wall Street likes to look at, but what do you like to use from more of an investment perspective, maybe contrarian perspective too, to see if certain things are weakening where you start loading up on stocks?
Yeah, that's a great question. We do a lot of factor work. We do a lot of work on spreads between sectors and attribution, and then tying that to where we are in the economic cycle. So just looking at rates of change on different indicators on the economy, both real time and jobs growth, and basically trying to link those two pieces together. So our story for 2023 had been avoiding recession, and we thought that would be good for earnings, and that's by and large played out. And the story for next year is sort of more of the same, but at a much smaller level. No recession, very slow earnings growth, and eking out mid-single-digit gains in earnings.
How about outside the U.S.? Any opportunities there for you guys?
It's been a really tough area. Every time we and others look at it, there's that nice-looking valuation gap that never seems to close. And the challenge there, I think, is growth. Asia growth has been slowing. Europe's had a really tough time generating growth. The sectors that are growth-oriented in terms of generating organic earnings are really in the U.S. And so it's very hard to get excited about those areas. There are, of course, great companies that are very undervalued because they're based overseas, so there are some selective opportunities, but more of a stock-picking opportunity rather than a broad-based international play.
All right, Robert, thanks so much for joining us. Really appreciate it. As always, Robert Teeter, he's head of investment policy and a strategy group at Silvercrest Asset Management. Looking at these markets, holding on to some modest gains here. The S&P 500's up about 0.4%. The Dow up 0.5%. Russell up 1.5%, so that's better breadth,
right,
as the technicians like to say.
And S&P 500 about 0.8% away from a record.
You got that factored into your screen, don't
you?
Of
course.
That's good stuff. All right, we're gonna have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. It's a victory in court for Kenvue. The maker of Tylenol won a lawsuit claiming that when taken on a prenatal basis, the drug could cause autism and attention deficit disorder. Bloomberg's Abigail Doolittle has analyst reaction.
JP Morgan analysts are saying that this is, quote unquote, a clean sweep for the defendants and that it, quote unquote, effectively collapses the plaintiff's case in the multi-district litigation. Other analysts, though, say that the possibility of a lawsuit dismissal, because Kenvue is saying that they are going to seek that the case is dismissed, reduces but does not eliminate the litigation risk, mainly because there could be a lengthy appeal process.
Kenvue is up more than 5.5%. Weight loss drugs are all the rage, and Amgen certainly knows it. The biotech was upgraded to outperform at BMO Capital Markets because of its potential in the obesity drug space. Bloomberg's Katie Greifeld has details.
Analysts there saying that Amgen, quote, has unappreciated potential when it comes to the obesity drug market, and that the biotech's developing pipeline gives investors the opportunity to play in this space without paying the same premium that you'll find when it comes to Amgen's peers here. Now, as a result, BMO says that Amgen may be the 2024 value obesity play.
Amgen is up about 1.5%. And airlines like Lufthansa and EasyJet, well, they're on a shopping spree for planes. And Airbus and Boeing, they're taking in record orders. The plane makers are now practically sold out for the rest of the decade on their most popular models, putting the pressure on carriers to join the frenzy or risk being put to the back of the line. Airbus ADRs right now, they're up about 0.6%. Boeing up about 1.5%. Those are the stories we're following. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, a solid day in the markets here. We have S&P up 4%. 0.4%. The Dow up about 0.5%, and the Nasdaq up about 0.5%. The real action, the real movement's on the Russell, with the small cap stocks up 1.5%. Yields come in slightly. 10-year Treasury 3.91%. WTI crude oil up about 1.5% here on lingering continued tensions in the Middle East. $73.50 per barrel for WTI crude oil. Right now, let's head down to Washington, D.C. We'll get rolled to national news with Amy Morse.
All right, thank you, Paul. Defense Secretary Lloyd Austin announced a new maritime task force intended to protect commercial vessels traveling through the Red Sea. The ships have come under attack by drones and ballistic missiles fired by Houthi militants. As a result, a number of shipping companies are diverting their fleets around Africa. We get more with Guy Platten, International Chamber of Shipping Secretary General.
We absolutely condemn what the Houthis are doing to merchant shipping. These innocent seafarers are now being put at risk, and shipping has a right of innocent passage and is against all international law. What we do welcome is this broad coalition of navies to help protect and add security into the Red Sea.
Guy Platten of the International Chamber of Shipping. Critics say controversial border security legislation signed by Texas Governor Greg Abbott yesterday could lead to the mass arrests of migrants. The governor says the goal of Senate Bill 4 is to stop illegal entry into the U.S.
For repeat offenders, it creates the offense of illegal reentry with a potential prison sentence term of up to 20 years.
The ACLU plans to sue. Overnight in Iceland, lava fountains soared into the air, lighting up the night sky after a volcano in that country's most populated region erupted. In 2010, a different volcano erupted in Iceland, creating an ash cloud that wreaked havoc on transatlantic air travel. Paul Segal is a professor of geophysics at Stanford University, and he says they don't expect that to happen this time.
There are a range of different styles of eruptions. Some produce a lot of ash. This is not one of those. This is producing lava flows, so they're very hot and they're very fluid.
Now, the lava flow so far has shifted away from the only town in the area that had been evacuated last month because of this volcano. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
Amy Morris, thank you so much. We appreciate that. So, Amy, I'm under the impression that we have a very strong team of markets reporters, star reporters who cover the markets. Is that the case? Do we have? And what are they writing?
I thought you were throwing to Amy.
No, it's thrown to you.
Oh, okay, sorry. You said Amy's name, so I was thinking, I was like, wait, I was waiting for her to chime in.
So what do our markets reporters do? Because you're one of them, aren't you?
Well, thank you, Paul. That's quite the compliment. But yes, I do some reporting. Actually, I am an equities reporter. So I'm the deputy team leader for the U.S. stocks team. So we have a taking stock column that we write, and this is what I crunched for today's data. So I took a look at EPFR global data. So this is something that traders watch each week. Typically, the data goes through the week ended through Wednesdays. So I took a look at the analysis from what they had specifically on Fed Day. And on that day last week, $24 billion on a net basis was poured into U.S. equity funds. So that was the biggest one-day total in about a year. But heading into that week, actually heading into Wednesday, the data was just around $1.4 billion for the week. So it shows you just how much money flowed in that Wednesday in the wake of the Fed decision there. So when I was speaking with them, Cameron Brandt over there, he's the director at research at EPFR. So they still have preliminary data that they're trying to gauge for Friday as well as on Monday. But on Thursday, another $15.7 billion actually went into those U.S. equity funds. It went into large cap growth stocks, large cap value stocks. It was a little bit more on the value side, though, but a lot of those we know have been pressured this year. But they're waiting to see if that money, continues to go through in the next few trading sessions. But that was a big move there, $24 billion into U.S. equity funds on Fed Day.
Investors are now the most overweight equities relative to cash since January of 2022, according to the Bank of America's Global Fund Manager Survey. So that's pretty interesting. I guess we've seen that just in the price performance over the last 6, 7, 8 weeks. It's been quite the move as we finish out the year. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with a Bloomberg Markets reporter, Abigail Doolittle. She'll join us here to give us a sense of what's happening in the markets today. Again, some green on the screen. Then Lee Klaskow, senior logistics analyst with Bloomberg Intelligence and Transportation. He's going to talk about FedEx. They're reporting some earnings here. And we also want to get his thoughts on the global shipping issues, particularly in the Red Sea, how that might be affecting shipping lines. He covers all the shipping companies as well. And then the macro view. Jeffrey Hirsch, CEO at Hirsch Holdings and editor of the Stock Traders Almanac.
Seasonality.
Pretty cool. So we're going to have him on to talk about this market. He's been bullish on this market. He's been correct.
He has.
We'll get his thoughts about seasonality, small cap stocks, and the look forward.